incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Equities positive here by just 0.1% on the S&P 500. Under surveillance this morning, calling for Powell's resignation.
He should resign immediately. We should get somebody in there that's going to lower interest rates. Why don't you call for his resignation?
Do you want congressional Republicans to investigate and pursue?
Okay with me. I think he's terrible. I think, look, we're paying, I call him too late. He's always late. But he wasn't late with Biden before the election. He was cutting him like crazy. It didn't help too much, did it?
It's the latest this morning. President Donald Trump calling for Fed Chair Jay Powell's immediate resignation. The race to replace him said to be narrowing down to NEC Director Kevin Hassett and the former Fed Governor Kevin Walsh. The Wall Street Journal reporting Hassett met with Trump at least twice in June to discuss the role. Joining us now to discuss that and global markets, Andrew Sheets of Morgan Stanley joins us now for more. Andrew, good morning. You're the lucky one. You get this question, okay? Here's the menu. On the menu, equities, the long bond. Lisa wants to talk about that, the US dollar. What would happen if Kevin Hassett got the nomination from President Donald Trump?
Well, thanks. Good morning. It's great to be here. And look, it's hard to speculate on any specific, nominee or action. But I think if what we're talking about is the administration looking for a Fed that will run more dovish policy, all else equal, this is, I think, consistent with a weaker dollar. This is consistent with a steeper yield curve and higher term premiums. And, for equities might take that initially more positively. But I do think the key story here, and I think we're already seeing this. We're already seeing this in the weaker dollar. We're already seeing this in the steeper yield curve, is I think the market is already injecting more risk premium into certain U.S. assets, given longer-term uncertainty over Fed policy and also longer-term uncertainty over the U.S. fiscal path, which just got more complicated with the passage of the latest budget bill.
Lisa talked about this yesterday, this dynamic, and I think you're dead on. The president is telling you exactly what he wants. He wants a lot of issuance at the front end of the curve, and he wants the Federal Reserve to drop interest rates.
Essentially, this is a backdoor monetization of the fiscal deficit, because if you end up lowering rates to zero and then issuing at the front end, well, why not? At the same time, that could potentially boost inflation. Why are you bullish on long-duration credit, given that potential backdrop?
Sure. So, I think credit is the other side of this story, this large public sector deficit that we see, 8% of GDP, 7% of GDP, 8% of GDP. Well, it's a private sector surplus. The household balance sheet, the household net asset position is very good. The corporate balance sheets are in very good shape. Right. One of the reasons why that deficit is so large is we've cut corporate taxes, which is good for that corporate balance sheet, good for those corporate cash flows. So I do think investors could say, look, on the corporate side, you have more flexibility about where you're going to issue. You've got attractive yields. You've got long duration IG in the U.S. at 6%. That's that's probably 400 basis points over inflation. 3.5% over inflation. That's an attractive real rate of return in a world where I'm less certain maybe about the long-term fiscal trajectory of the U.S., maybe a little bit less certain about the issuance pattern, and corporates are a good place to hide out.
Let's put corporates aside. Just do a thought exercise. If the Fed were to do that, if essentially there would be a backdoor monetization of the fiscal deficit, what would that do to inflation, given that it would probably weaken the dollar that much further? And this is not an insulated economy the way that some people are aiming to make it.
Well, look, I mean, if the premise is that, if the scenario you were talking about here is that the Fed's going to fundamentally run lower interest rate policy, easier policy than one thinks it theoretically should, that probably should absolutely mean higher inflation, all else equal. And not only that, it should mean higher risk premium above that level of expected inflation. So it's a double whammy there. And I do think that that's consistent with a steeper curve. Our rate strategists do think that the TIPS break-even curve should steepen. So we see a steeper yield curve in nominals. We see a steeper break-even curve. That's not necessarily about any expectation that the Fed cuts to zero. We think they cut to 2 5/8 by the end of 2026. But this idea that more risk premium will get injected into the long end of the curve, I think is very consistent with how we're seeing things.
2 5/8 by year-end 26. When do the cuts begin?
So we think they happen kind of around the first quarter. So we don't think there's any cuts this year. And this will make it maybe a little bit awkward with the Federal Reserve and the administration. But what we think will happen is that you're going to see inflation pick back up. You're going to see core PCE at the end of this month, at the end of August, at the end of September, start to reflect some of these tariff effects that we know or that we think are in the data and are coming in. At the same time, given lower immigration in the U.S., we think kind of break-even job growth in the U.S. is a non-farm payroll number below 100,000. So we think for the Fed, which is doing much better on the jobs mandate than the price stability side of its mandate, if inflation's picking back up, if payroll growth is in line with steady unemployment, they should be on hold, we think. And that will keep them on hold for longer, and then they'll cut later and probably more in 2026 as growth continues to slow.
But Andrew, inflation has been coming down, and we still have tariffs. So why do you think it's going to pick up in July?
So I think this is where this month's number is so interesting, because on our forecast, on Morgan Stanley's forecast, the number we got at the end of June was the last good number for a little while. And now we think it's starting to pick up. And I think what's interesting is that in those categories of inflation that we think should be most tariff impacted, we've seen some of the least impact on prices, which we think is more of a function of a delay in the data. It's a function of how retailers might be selling off inventory acquired at old, better prices, but we think that is coming. And so if you add that with also, further tightening of the labor market, again, lower immigration, that's a tightening negative supply shock in our view. We think that the core PCE number at the end of July, at the end of August, at the end of September, that picks back up, and then we'll start to see this. This is a huge debate, though, but that's what we expect.
So if the data for this Fed shows that they cannot cut, and this is going to be potentially, as you say, awkward with the administration, do you think there's more of a chance Trump leans into putting in a shadow Fed chair?
I think that's difficult because, again, I think talking in those hypotheticals, talking in the theoretical is always challenging. I think this idea that in a scenario where the Fed is on hold as we expect, as growth is slowing, as I think the administration has made it very clear that it thinks monetary policy should be easier, I think assuming that there would be more friction, more criticism of the administration towards the Fed is probably a reasonable assumption to make. And again, I think this is maybe part of the case why those risk premiums further out the curve should be higher. The market thinking, well, maybe this will drive a larger shift in the next Fed chair's philosophy or who is picked, given the greater attention he potentially get this year.
Andrew Sheets of Morgan Stanley. Andrew, clinic, thank you, sir. Andrew Sheets of Morgan Stanley and the team at Morgan Stanley, Mike Gapin, of course, expecting no rate cuts in 2025.
Which amps up potentially the tension. I'm just thinking through, if you get somebody in who really is going to cut rates to 1%, 2%, how much you see a massive blowout in terms of long-term rates, what this does to the mortgage market, whether this completely restructures what people demand even on the front end. Because if you know that the U.S. government has to finance its entirety on the front end, why not charge 5%? Hold it all in T-bills and call it a day.
It's great to have Bramo Bear back. You went missing for a little while.
She hibernated for a little bit.
I mean, honestly, it's hard to get bearish when everybody's so bearish it doesn't ever come to fruition.
But now they're bullish again.
But now they're bullish again.
Yes. Coming up on the program, John Bavan of BlackRock, Ed Mills of Raymond James, Jay Bryson of Wells Fargo, the former senior White House trade advisor, Kellyanne Shaw. The second hour of Bloomberg Surveillance, up next.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
It's becoming more difficult to get extremely bullish on the index at these levels.
There's a very, very decent chance that we actually do squeeze, and we do squeeze a lot higher.
The long view is still quite optimistic.
There's broad participation in the market, but the magnitude of the upside is just in a handful of names.
The market has been going higher, and it will take a meaningful shock, I think, to disrupt that.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P just about positive by 1/10%. On the benchmark stateside, following 2 days of very mild losses on the S&P 500. Your day ahead is shaping up as follows. Later on this afternoon, some Fed minutes. An important one, though, an auction at 1 p.m. Eastern Time. of 10-year bonds.
$39 billion of those longer duration U.S. Treasuries at a time where there's a real question about what this asset looks like going forward, a real question about U.S. exceptionalism and what this government would like to do with the deficit if you're going to be issuing more on the front end, short-term debt, and maybe phasing out the long-term debt at the same time that you've got a Fed chair, potentially a new Fed chair, that wants to cut rates significantly.
Let's talk about that new Fed chair. The Wall Street Journal out with the report overnight, narrowing it down to two names, the two Kevins.
Kevin Hassett and Kevin Warsh. So Kevin Warsh was an individual that really rose to prominence within Trump orbit when potentially he was going to be the Treasury Secretary, and the reporting on the Wall Street Journal is that he's set to go down at some point, have this meeting with Scott Bessent. Then there's Kevin Hassett, who is the president's current NEC director. And what's interesting about him is the Wall Street Journal says he already had 2 interviews with the president, specifically talking about the Fed chair position. And then you can see the change of tone, even this entire summer we've had so far, from Kevin Hassett, who used to say things like, it is my job as the NEC director to make sure that the Fed is treated independently, to basically saying Jay Powell is a Democratic puppet and he listens to Elizabeth Warren. His tone has changed since his name has entered the ring.
Just because you believe the Federal Reserve should lower interest rates, I don't think implies that you're political biased. There is some credible arguments out there for lower interest rates. What will matter is perception, how the market will perceive the nomination. That's really important here. And as we've said a few times on this program over the past few weeks, the market will get a vote long before the Senate does when the president picks a name.
And to your point, this is a nuanced debate. This isn't about cutting rates or not cutting rates. This is about how much you cut rates and in response to what kind of economic data. Right now, we're looking at a market that's pricing in about a 65% chance of a September rate cut. That's baked in as more than a 50-50 chance. You have at least 2 or even 3 rate cuts priced in by a lot of different shops around Wall Street. So it raises the question, what would be fiscally irresponsible? What would be irresponsible from a monetary policy point of view? And that ultimately lies with the inflation data. If inflation is not coming down and you still see a Fed chair that is getting jawboned into lowering rates in a significant way, watch out for the fireworks.
CPI, July 15th, a week yesterday. Look out for that next week alongside earnings as well. This equity market at the moment, though, taking everything in its stride. The president promising more tariffs and saying there will be no extensions. And equity futures are positive by 0.1%. And yesterday we were down by what? 0.1%. Coming up on this hour, we'll catch up with Jean Bavin of BlackRock and why he's staying overweight U.S. equities. Ed Mills of Raymond James as the White House rules out further extensions. And we'll catch up with the former senior Trump trade advisor, Kellyanne Shaw. We begin this out with Stock Steady as investors digest President Trump's latest trade threats. Jean Bavin of BlackRock writing, we now see even more cause to stay risk on and overweight U.S. stocks. Jean joins us now for more. Jean, good morning.
Good morning.
Just explain yourself, sir. Why?
I mean, it boils down at the end of the day, huge amount of uncertainty. Of course, we've been going through that this year. We don't think there's much insight in saying that anymore. It's really about how you get a handle on this. And I guess our strong conviction is that, when you look over the near term, we have more certainty about the outlook than we would have over the next few years. So that's a very unusual environment we are in right now. And over the near term, the world cannot change very quickly. There'll be, noise, there'll be headlines, there'll be attempt to do stuff. But there are immutable laws at play, and that's going to shape the outcome. So we tend to, overall be, pro-U.S. assets, and at the same time, try to fade the extremes that you're going to see coming both ways, actually.
There is a distinction, though, when you say overall be pro-U.S. assets between stocks and bonds.
Yes.
What is the difference?
Well, the difference is that, we like equities and bonds, I think, are more tricky in this environment. And so U.S. equities, we think there's powerful mega forces that are at play. AI is a big theme. We continue to believe in that. That supersedes, I guess, the near-term trade noise and so on. But when it comes to the bond and fixed income, but government bonds in particular, we have a lot of things at play that are, for us, pointing towards higher yields, higher long-term yields, term premium that needs to reappear. And so we remain underweight, U.S. Treasuries as a result.
Is this a U.S. story or is this a global story at a time when I believe that you prefer European bonds, even though they're still issuing a lot of debt and facing some of the same kinds of issues?
It is a U.S. story to the extent that we think that's where the repricing is the more serious. It's also related to the greater uncertainty we have around the Fed outlook, the inflation outlook, the debt picture. Whereas in Europe, I mean, Inflation is on the way down. You can tell a very credible story for why inflation will surprise on the downside. The ECB has more room to cut even from here. So that leads to, more support for European bonds.
So overweight U.S. equities, underweight U.S. government bonds, while you're overweight European government bonds, maybe underweight European equities. I'm just wondering if you could give us a sense of the last time, just to sort of frame this out, that you were less exposed to U.S. Treasuries, particularly on the longer duration versus European ones. When was the last time you had this dynamic in BlackRock's portfolio?
Well, we've been, for the last few years, constantly underweight U.S. Treasuries. So we've been of the view that inflation was a structural phenomenon in this environment, that rates will need to adjust. There's a fiscal story that is not the new thing of this year. There's been a deficit story post-pandemic that was putting pressure on yields. So that story has been with us for a few years now. That has been one of the strongest conviction we've been having throughout that time. And there's been new layers now added to this, which it's unusual to say we've been structurally underweight U.S. Treasuries for so long, right? You would have been tactically moving around that, but that's really like a lasting story for us.
When it comes to these new layers, you're probably mentioning, at least thinking about the one big beautiful bill. Why didn't we see more pushback from the bond market?
Well, I think there is a lot of structural demand still for U.S. Treasuries. So the reason why we're underweight is not a bigger sensational story around U.S. exceptionalism being questioned, or it's not about U.S. Treasuries not playing their safe asset role as much as they had in the past. So we're not questioning the fundamental structure of the. And there's going to be a need, a structural demand for this. So I think the markets are adjusting. There's no panic so far, but it's on drifting up. I think there's room for digesting some of the big beautiful bill that came through, and then there's a lot of question now on how it's going to come next. And so I think it's going to be up. Yields are going to go up. It's going to be absorbed over time towards with higher yields.
You're saying this at a time when the president's talking about sending out more letters where tariff rates look very similar to what happened on Liberation Day. Do you think Trump has primed the market to basically absorb his aggressive policies?
Well, I don't know if the president has primed the market in any way, but I think we have more conviction ourselves since April 2nd and April 9th that what I talked about before, the immutable laws cannot change quickly in the near term. And one part of it is the bond market, to actually connect to the previous discussion. The U.S. relies on foreign funding for that debt that we're talking about. That's maybe something that we would wish to be different, but that's the starting point. That cannot change overnight. And I think that's going to limit the maximalist approach that you can expect to see. And we've seen that on April 9th. To us, it was the bond market that really provided the discipline at that point. And we've seen it, so I guess that gives us more conviction that going forward, that's going to still be a constraint for the time being, at least.
That's an interesting thing to think about. Do you still believe that any potential sell-off in Treasuries will be self-limiting because of that very fact?
I think so. I don't think the U.S. can sustain a massively higher yield. Even though we are underweight and we think yields are going to go up, it has to happen in a fairly gradual manner. And if there's any sign that this is like a very quick resetting, and we're in a world where we have 5% 10-year yield quickly on a sustained basis, the whole budget arithmetic that is already pretty challenged, I think, is out of the window.
So 5% is like a ceiling for you on a 10-year?
Well, I think if we're sustainably in a 5% world, I think that changes the picture quite a bit. I don't think it's a ceiling. I mean, will depend on what the growth outlook is and so on. So I don't think there's a hard ceiling, but it's a different world if we are adjusting to 5% sustainable.
Well, can I ask you then, why is it so different, given it's only 60 basis points away? Why is 60 basis points so important?
I think it's not so much the 60 basis points, but this is now the kind of the norm, 5% that we expect to see over the next few years. That is a different world than we had 4.4. It might bounce back and up. So that's more a sustained aspect.
Even the team have been pretty consistent about this now for a number of years. At a time when a lot of people have started to price in rate cuts, back away, then price them in again. You've been very consistent about this. There are structural reasons to expect inflation to remain higher, and you think bond yields remain elevated. How convinced are clients of that story right now when you tell it?
Well, I think I find this, we're very convinced about this story, and I think, there's different views out there, but I think it's less now, we have less pushback than we would have had maybe, when we started to hold that view in 2022 and so on. So I think this has become, in some ways, more consensus, so less pushback, I guess, in that sense. But yeah, no, I think that's not an easy, hard sell, I guess.
John, appreciate your time. As
Thank
always,
you so much.
Jean Bavin there of BlackRock, looking for limited rate cuts from this Federal Reserve, if any at all, in line with what we heard from Morgan Stanley about 15 minutes ago.
With inflation really pressuring them to hold off on those said rate cuts at a time when Europe can potentially cut rates more significantly. Just picking up, though, on the self-limiting factor. I think that's important. This idea of if you start to see some sort of freak out, for lack of better words, in the long-term bond market, does that curtail some of the behavior to limit some of the more extreme scenarios that I was portraying about 5 minutes ago?
No big freak out, Alabramo, in the bond market right now. The 10-year at the moment about 440. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Donald Trump has vowed to push forward with his aggressive tariff regime, stressing his August deadline is final and he'll not be adding additional extensions on country-specific levies. Instead, hardening his tariff threats on copper and pharmaceuticals. And investigations are underway in the deadly Texas flash flood. They're looking into when weather forecasters advised local officials about flooding and what those officials did to spread the message to the thousands in the area. The floods killed over 100 people and 161 remain missing. And a leadership shake-up at Apple. COO Jeff Williams is retiring from his post later this year with plans to continue to oversee the design team and manage health initiatives. 30-year Apple veteran Sabi Khan will replace Williams as COO. And that should be my brief, John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. That stock is not in a good place. Apple's still down on the year by 16%. Up next on the program, no extensions.
What incentives do countries have to negotiate? It seems that deadline keeps moving.
We didn't move, no. It's always been August 1st. August 1st, they pay.
Up next, Ed Mills of Raymond James, live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Equity futures positive by 0.2%. This market's getting comfortable. Investors getting comfortable with all these tariff threats. I mentioned Bank of America. Dangerous to underestimate corporate America. Steve Chevron over at Federated, the market will get comfortable with new levels. And Goldman's David Kostin, we expect the digestion of tariffs to be a gradual process. We are looking through the risk going into August 1. Under surveillance this morning, no extensions.
What incentives do countries have to negotiate? It seems that deadline keeps moving.
We didn't move, no. It's always been August 1st. August 1st they pay. And everybody pays, everybody has to pay, and the incentive is that they have the right to deal in the United States. If they don't want to, they don't have to pay, and they don't have to deal here. But if they want to buy and make a lot of money and sell in the United States, they have to do that.
Here's the latest this morning. President Donald Trump vowing not to extend his trade deadline beyond August 1. The president saying he plans to release trade updates for at least 7 countries later on this morning. Bloomberg's Tyler Kendall joins us now for more. Do we know who the 7 are, Tyler?
Yeah, hey, John. No, not at the moment, though we have gotten some indications on which countries could be gearing up to get a letter. On one hand, we know that those countries that President Trump has grown frustrated with were prioritized for letters, like how we saw Japan and South Korea get letters the other day. Perhaps that could indicate that some of those other trading partners, like India, for example, that President Trump keeps highlighting could be in the mix. But he did give us at least one really firm answer, which is that the European Union could be getting a letter in the coming days. That's considered to be kind of surprising since the European Union has been making progress towards a deal, with people familiar telling Bloomberg News that they are nearing a technical agreement in principle, with negotiators really focusing on getting carve-outs when it comes to the sector-specific tariffs. And that is why this new threat, particularly around pharmaceuticals and copper, is only going to complicate these negotiations for our trading partners going forward here. Because while we knew that the administration had launched these Section 232 investigations on the basis of national security concerns, the original intent was that they weren't supposed to be negotiated. They were supposed to have that more durable basis here for the administration. But now they've really come into the conversation in a meaningful way. John, when it comes to those copper-specific tariffs in particular, while we didn't know the date or the rate, 50% is considered to be, of course, pretty high. While it is in line with the steel and aluminum tariffs, it is higher than the original baseline we were expecting for sector-specific tariffs at 25%, which is only going to make those carve-outs that much more important.
Tyler, thank you. Tyler Kendall down in Washington. With us here in New York, Ed Mills of Raymond James. Ed, good morning.
Morning.
It is July 9th, and we have limited clarity. How much additional clarity will we have on August 1?
We'll have more clarity. I don't think we'll have a lot of the details. I think the whole goal this year is to get as many MOUs signed as possible, because I think what President Trump really wants to do is say, I got a trade deal with 112 countries. They're going to buy trillions of dollars worth of goods, even more trillions of dollars worth of market access, and we're going to work out all the details later. And I think that one of the good things about having this little extra time is what you need to do to get one of those MOUs is not all that complex. If you can work it out later, that's fine, and that's where I think the market is okay. As long as we have this extra time, sign the deal, and when you look at the letters that are going out, the new rates are not that much worse, or sometimes even a little bit better than April 2nd, so we're okay.
The new rates are basically April 2nd. It's basically Liberation Day Part 2. But in this letter, Trump does say that perhaps you could consider adjustment to this letter if you decide to come to the table. We may reconsider. But then yesterday he said, it's August 1st. These are the rates. We're not going to be adjusting. Which Trump do you believe?
The next Trump? I mean, it's like there is the only constant here is change. I mean, so I don't necessarily think that August 1st is necessarily a hard and true date. I don't necessarily think these rates are hard and true. I do think that there is going to be 3 buckets here. Bucket number 1, new revenue. We have a huge new tax bill that is costing trillions of dollars, the most expensive bill in the history of the country. He needs that revenue. Bucket number 2, protect national security. Those are the sectoral tariffs. If we are at war with China, what do we need to make here in the United States? And bucket number 3 has always been, can we use the force of the U.S. economy to force policy change elsewhere? That piece is always going to be the hardest part, and that's what all these negotiations are about, Anne-Marie.
So who gets a deal today or tomorrow? I'm thinking of 3 in particular. Japan was supposed to, but they got the same second rate. India, I was getting tons of text messages yesterday saying it was imminent. I still see no language on it. And the European Union, which seems to capitulate on a 10% across-the-board tariff.
Yeah, I think the most likely is India, then Japan, and I think the least likely is the EU. I think one of the issues with the EU is the United States is asking Europe to make a decision. Are you with the United States or are you with China? And there are competing interests. You look at certain countries, and they're like, absolutely the United States. A lot of that economy is tied to us. Others have more exports going into China. Because they are a bloc with disparate interest, I think that's going to be very hard to get anything on the tape by April 1st. But I do think that Japan, India, Australia, a large part of the GDP globally, can get a deal by August 1st.
Don't want to get into psychoanalysis here. What is it, though, about letters? Because it's always a letter. Why does everybody get a letter? And what is the importance of this versus just a verbal warning, maybe a presidential tweet? You know, what is it about a physical letter getting sent out that it has some import for President Trump?
Yeah, I think it shows action. I think it shows the kind of the ability to kind of flesh it out a little bit more. You know, these letters, if you read them, they're basically the same, and they are very clearly dictated exactly by him and probably edited by him, because it's like you see Trump's voice in these letters. I do think that there has been a concern by President Trump that the taco trade is out there and that he always caves, so he wants to show and project this strength that if you don't come to the table, this is what you get. I think the biggest questions from the social media posts in these letters are some of the details. What does it mean that you'll have higher tariffs if there's transshipment? We do not have a structure in place to deal with kind of how that country of origin would be different. That's why I think the details here are going to take a long time, but he wants to say, here are the general parameters. This is what I want. You come to the table, you tell me what you're going to give me.
I'm taking notes, parenting notes, because I plan on sending letters to the household, and we do have a complaint box already. I am wondering going forward whether the reaction or non-reaction that we're seeing in markets is sort of emboldening him to send some more letters and to raise those rates up even higher.
Yeah, I think that's one of the big questions from clients yesterday at Raymond James is that after April 2nd, what got him to pause these on April 9th was the market reaction. And we've had these conversations so many times. What caused Congress in the past to raise the debt limit is the market reaction. And so are you in this dangerous place that if there is no market reaction, then you can get even more aggressive? And at what point is a mistake made? I don't think we're close to that, but I do think there's always a threat that if you need the market to correct and you don't get it, then you get more bold. The biggest change I've seen so far in this market is early on in administrations, they mostly focus on process. Later on, they focus on outcomes. Right now, this is a market that is saying, all right, the process might be changing, but the outcome is not likely to change. The only way we get a market reaction if they think the outcome is actually going to be materially worse than what they actually expected.
What would a mistake be? How do you characterize that?
Yeah, I think a mistake would be actually going to 50% with the EU and that sticking on for a period of time. When I was in Europe 2 weeks ago speaking with investors at Raymond James, there is a real concern about the weakness of the dollar and exports getting more expensive coming from Europe into the United States. And then you have tariffs on top of that. That could be a recession. Does that kind of have unintended consequences? We talk about, looking at yields here in the United States. We saw after April 2nd, the 30-year go above 5%. Does the 30-year kind of in the 10-year start spiking as we start issuing debt over the next couple months to refill the Treasury General account? And does he put pressure on the Fed to bail that out? And then there is a bond market reaction. Those are the things that I think are the biggest debates for the second half of this year is kind of the rate path.
That last point, the Federal Reserve. What are you telling clients about the Fed race?
So I think that I know that there is news out this morning that Hassert and Warsh are considered to be the front runners. I'd put Waller and Bessent into that camp as well. I think Donald Trump loves people to compete for the job. What I'm watching to see is, does Michael Barr step down as one of the Fed governors now that he's no longer vice chair for supervision? If he does, Hassert or Warsh is probably going to get that seat. Kugler, another governor, her term expires in January. That is probably the second seat. And then all four compete to see who can be the Fed chair come the May expiration of Powell's seat, and who's going to be the most dovish, who's going to be the most supportive of his agenda, gets it. It's a perfect scenario for Trump to have another game of apprentice, but this time for Fed chair.
Or Game of Thrones, equally as brutal. That situation, some names are more credible than others. Let's put it that way.
Yeah, or Bachelor. I mean, who gets a rose, right? I mean, we could put this on a whole host of different shows. This does raise a question, though, about how much the market's going to be voting, to your point. Who they're going to vote off the island. Love Island, maybe another one.
Yesterday, when the president was once again saying that Jay Powell is terrible, he then looked over to Scott Bessent and said, "I like you better." And that made me think, oh, maybe Bessent is back in this race and it's not just the Kevins.
Can you imagine these guys on Love Island?
I was just going to say, this
yeah,
is like
you
toxicity.
mentioned it. I don't know where you're going.
I mean, it just feels, like, playing for the love, and you only get love if you say what I want, and that's sort of a toxic relationship.
I know you watched Love Island.
Want to know more about the complaint box? Save that for another time.
It's true. It comes out once a week.
Okay. Ed Mills and Raymond James. Ed, thank you, sir.
Thank you.
Appreciate it. Up next, Jay Bryson of Wells Fargo on the health of the U.S. consumer, plus Yahara Anand with your morning movers. And again, a thanks to Trump's levy on copper.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Live from New York City, welcome to the program. 2 days of losses on the S&P, a small morning of gains so far. We're positive by about 0.2% on the S&P 500. On the Nasdaq, we're up by 0.16. It has been a snooze in the last 24 hours. In the bond market, check this out, 10-year Treasury. That maturity yields higher for a sixth consecutive session. The grind continues, up another basis point to 440.72. The debate at the long end of the curve, whether inflation will firm up in the coming months and prevent this Federal Reserve from reducing interest rates. But for this Federal Reserve, it's not just about credible economic arguments, it's about the politics of the moment. The president's saying we should get somebody in there that's going to lower interest rates. What does the former Fed Governor Kevin Walsh say? Tariffs are not inflationary. That's the argument at the moment if you want this seat at the Federal Reserve.
So we have Waller, we've got potentially Hassett, we've got Kevin Warsh, we have Scott Bessent. Real question is, how much does the market absorb the potential for rate cuts without freaking out? And the freak out being 10-year yields spiking higher. And that ultimately will be the true test of someone who can credibly be Fed chair, who could actually be pleasing to the president.
A big debate ahead of a 10-year auction later on this afternoon. $39 billion in 10-year notes. We'll come back to that later. 2 hours away from the cash open. Let's get you some morning movers. Here's Yahara Anand with more. Hey, Yahara.
Hi, John. We start with Freeport-McMoRan. Shares of the American mining giant are up nearly 2% after President Trump called for 50% tariffs on copper imports. So obviously, as the largest copper producer in the U.S., Freeport stands to benefit from this, since those tariffs will make foreign copper more expensive. And a little fun fact for you, the Morenci mine in my home state of Arizona is the largest copper mine in the U.S., and it is operated by Freeport. Next up, we have AES. We mentioned this stock earlier, but worth mentioning again because it is up nearly about 14.5% on our reporting that it is exploring a potential sale, and apparently the likes of BlackRock and Brookfield are interested. That's because its shares have lost about half their value in the past 2 years, but this is a company right in the middle of that AI energy demand frenzy, and it's already supplying power to the likes of Microsoft and Amazon. And we end with another energy company, and that is Bloom Energy, rising 7.6% after JP Morgan upgraded the stock to overweight and nearly doubled its price target to $33. They're saying revenue at the company could get a boost after fuel cells qualified again for federal tax credits under the tax and spending law. That was not expected, but it is a big win for Bloom. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, President Trump expected to issue more tariff letters today as he vows not to extend his new deadline of August 1st. The president saying he plans to release trade updates for at least 7 countries this morning.
And how credibly will that be taken, given the fact that the market has shrugged pretty much everything off? The prospect of the EU being one of them is pretty shocking, given the fact that we thought that they were somewhat close to some sort of deal, and it raises the question, how badly are some of these negotiations actually going, that he's finding the need to really ratchet up the pressure?
Well, the EU is just hoping to get some sort of framework in place by today, then have the rest of the month to negotiate this agreement. The president, though, yesterday saying there's no change to this date when it comes to August 1st, and there will be no change to this date. At the same time, his letters leave open this possibility that if you come to the table with something he wants, he's willing to change the parameters of the deal, the negotiation. So the market's basically saying, we think this is all open for debate at minimum till August 1st.
We've said 2 things on this program. The reason this has been somewhat disappointing to markets, I stress somewhat, is that July 9th today was meant to be a clearing event. It's not going to be. Going to have to wait till August 1. And based on the threshold the Federal Reserve set for itself, this is going to make it harder and harder for the Federal Reserve to cut interest rates, which makes this race to replace Fed Chair Jay Powell all the more interested. And it's said to be narrowing down to just 2 names now, the NEC Director Kevin Hassett and the former Fed Governor Kevin Walsh. The Wall Street Journal reporting that Hassett met with Trump at least twice in the month of June to discuss the role.
What do you think these conversations sound like? How dovish are you going to be? How many times are you going to cut? I mean, essentially, what are the parameters for President Trump to pick a favorite among what we believe to be the 4 major candidates, although, of course, there could be more, if there is this check by the markets? And I think there is a bigger question, which is, will the administration be beholden to a bond market that is concerned about some sort of monetization of the debt by issuing a greater amount of the debt in the front end of the yield curve, and then having a Fed that lowers rates as much as possible to reduce interest expenses? That's going to be a key question for the long end and for the dollar.
What they talk about inside these meetings is probably what Kevin Hassett is willing to say now publicly. As these meetings were going on towards the end of the June, this is what he had to say in an interview. Jay Powell's the person who cut rates right ahead of the election to help Kamala Harris and is, quote, doing whatever it is that Elizabeth Warren wants. That is what he is saying publicly, so you can only imagine what he is saying to his boss if potentially this is the job he wants.
I wouldn't usually be first in line to defend Senator Warren and some of her policies, but Senator Warren's been sending sending letters to Chairman Powell asking for lower interest rates, hasn't she?
She has been. They're on the same page. Yeah. The letters. I think I'm going to start writing letters. I'm just going to hold them up for surveillance. It'll be like the surveillance letter every morning. I just want to think we should do that.
Motivations matter, not just letters. And how those motivations are perceived matter a whole lot more to this market. You can have a credible argument to lower interest rates. We've heard it from Neil Dutta of Renmark. I find Governor Waller's speeches particularly compelling. They are credible. His view, his argument, why we should look through tariffs, look through any potential inflation shock, and insulate the labour market. But if you believe that the decision to cut interest rates is not because of a credible economic argument, it's because the president asked you to, that's going to have a very different outcome in financial markets.
The key question is going to be, does the inflation data allow the Federal Reserve to cut interest rates or the labor market if it weakens substantially? Or are you going to get more jawboning about the expense of all of the debt for the United States? If that continues to be one of the motivating features, watch out for that long end.
Protecting Fed independence should make it easier to cut.
Correct.
If you undo it, it makes it harder, because the market will start to question a whole host of things. Okay, we'll come back to the Fed a little bit later. Dan Ives of Wedbush, he's in focus, criticizing the Tesla CEO, Elon Musk, and his move to create a new political party.
This is a time now for Musk. He needs to choose, and you can't keep having these one step forward, two steps back. I think there's a line in the sand that he's now starting to cross. I believe you've now hit a point. I think the board's going to have to get involved.
Dan, these are not my words. They are the words of Elon Musk, pushing back and telling Dan Ives, quote, to shut up on X.
My favorite part of this is actually, if you look right under Elon Musk's tweet to Dan Ives, you have someone asking Grok thoughts. Grok, of course, being the generative AI chatbot from
They all do.
XAI.
Isn't that just like a feature of X now?
But this is perfect. But do you want to know what Grok actually said?
Grok say?
It sounds a lot like what Elon Musk would say, which I think is fascinating.
It is his.
Well, Dan's got some bold ideas. But capping Elon's time in politics, that's like telling a rocket not to launch. Musk's shut up sums it up. Tesla thrives on his chaos. As Grok, I'd say let the mad genius cook. I'll just say, it sounds a lot like Elon Musk.
Well, the thing is that Ives is one of the most bullish on Tesla, and Elon Musk is telling the biggest bull on the street for his own company to shut up. Because why? Dan continuously says that he wants Elon Musk at the C-suite, not on X, talking about political endeavors, talking about starting third parties in the United States, and wants him focused on things like autonomy, where he thinks that's why you can get to a $500 price tag on the stock.
To your point, he has got a $500 price target on Tesla. Let's turn to the consumer. Amazon Prime Day getting off to a slow start. Data from Momentum Commerce showing sales falling almost 14% in the first 4 hours of the event compared to last year. Jay Bryson of Wells Fargo writing the following. Indicators of domestic spending, including real PCE and orders for capital goods, have softened. Jay joins us now for more. Jay, welcome to the program, sir. Let's go with the first question. Do you believe the pull forward in the previous few months is starting to reverse? And are we starting to see some evidence of that?
Oh, yeah, John. We definitely are starting to see some evidence of that. I mean, you know, we're only 4 hours into Prime Day here. We'll see how all that shakes out. But, you know, if you look at recent spending indicators, they have all softened here in the second quarter. I guess the big question here is it just, you know, a reversal of that pull forward, something that will snap back later on this summer, or is this the start of a real trend? Our guess is it's the start of a real trend in terms of softer consumer spending data. You know, we're going to be looking at higher inflation in coming months. That will erode purchasing power. And so we're looking at some softer data, not negative consumer data, but just soft consumer data as we go forward.
How much, Jay, are we seeing companies that don't really want to reduce prices? They don't want to give massive deals ahead of potential margin compression in the face of tariffs. At the same time, the consumers are just buying less. So prices staying high, but people being less active, sort of the stagflationary-like scenario that some people have pointed to.
Yeah, I mean, we're kind of in that, you know, that scenario right now, Lisa, you know, in terms of just there's a lot of uncertainty out there in terms of you know, the effects of tariffs. I mean, the good thing, I guess, from the company standpoint is they brought a lot of inventory in the first quarter. They got underneath the tariffs. They have this inventory that they can sell right now at lower prices. You know, the big question is, as we go forward, is does that start to reverse? And our guess is you're going to see that in the numbers that are coming coming up, the June numbers for CPI next week. You'll see some higher goods prices. You're starting to see that starting to trickle in. And so, you know, the inventories can't last forever. And sooner or later, if these tariffs do stick, you're going to see higher prices as you go forward.
This is kind of an in-the-weeds question, Jay, but do we have a sense of how long the inventories are going to last? Do you really think that we will start to see some of that pressure in next week's CPI report, or could it be that people have stockpiled so much that we're not going to see it until much later this year, which will keep us in this sort of guessing game of will it or won't it really affect inflation rates?
Yeah, so you know, the answer to your question is it's kind of unknown. Our sense here is that you are going to start to see it in terms of trickling in terms of in the June numbers that we get next week, and then we'll start to see it over the next few months as well. I mean, I think it's a few month sort of phenomenon rather than, you know, between now and the end of the year. We think it's going to show up between now and, you know, let's say sometime in the early fourth quarter when we see the biggest impact of that reversing.
Jay, what do you think is going to have the biggest bite on the U.S. economy, the sectoral tariffs or the country-specific ones?
Well, I think it's more the across the board sort of rather than the sectoral ones. You think about the sectoral ones, a lot of those things are on steel and aluminum, you know, things like that, things that consumers don't buy just directly. And so it gets passed on through businesses, and whether it all gets passed on completely, you know, is a difficult question. But it's more of the across the board things, the things that can affect consumer prices directly, I think is probably the bigger effect on the price level and on the economy.
Jay, there is always something to worry about. In my experience living here in America for the 10th year, there's always something to worry about, and the economy turns out to be okay. Your experience goes beyond my 10 years. It goes back decades to the University of Alabama when you were assistant professor. Now wrapping up your career at Wells Fargo. There's a reason I'm doing this, of course, because this is your last appearance in your seat before you retire, sir. Could you share some wisdom with us this morning? What's your biggest lesson of covering this economy?
I'm sorry, John. What's my biggest what?
The biggest
worry?
lesson, sir. The biggest lesson you have.
Yeah, I guess the biggest lesson I have is the U.S. economy is A, very resilient, which I think you just pointed out, and B, it is very flexible as well. It's always changing. And so we always want to, you know, when a shock comes, whether it's a pandemic or whether it's a tariff or whatever, we always want to look back on history to figure out, you know, what the effects of those potential policy changes or those shocks were on the economy. That can only get you so far because, you know, again, the economy continues to evolve. And so history can tell us some things, but we have to stay sharp on our toes about how the structure of the economy is changing and how different policies and different shocks may affect it.
Jay, congratulations on behalf of the team here at Bloomberg Surveillance. Thank you, sir, for your contributions to this show over the years. Jay Bryson there of Wells Fargo.
Yeah, so wonderful to have him on the show, and hopefully he can go back in his new seat. It is important to say we cannot really understand a lot of the policies going forward and extrapolate them out too much. I will say with aluminum foil, I'm looking at prices right now.
That's what you're checking out?
Yeah.
The big takeaway from Jay Bryson, things turn out to be okay, and you're looking at foil and the price of foil.
You know, it's a foil hat. Right. You know, it's
on brand. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump said he will push forward with a 50% tariff on imports of copper into the US. The announcement sent copper prices plunging in the global benchmark. Trump looks to spur more mining and smelting in the US, and the tariff can be in place within weeks. And Starbucks has received several proposals from prospective investors in its China business. Sources telling Bloomberg the company is now in the process of shortlisting a group of potential investors for a next round of bidding. In a statement, Starbucks shared it remains committed to China and wants to retain a meaningful stake in the business. And Christian Horner has been let go as CEO and principal of Red Bull Racing after over 20 years with the team. Horner was the longest-serving team principal in Formula One and oversaw Red Bull's rise to dominance in recent years. His departure follows a series of issues both on and off the track over the past year. That should be my brief, John.
Lizzie, thank you. End of an era for Red Bull Racing. Adrian Newey, one of the most successful car designers of all time, if not the most successful. He went recently. Christian Horner, going now. Max could be next, based on reports we're hearing.
Yeah, that would be kind of a sea change, given that he's dominated the field to such a degree and popularized it through the Netflix series, etc. I wonder if they can maintain the popularity if you've got a changing of the guard at the top.
Someone just messaged me, maybe Horner goes to Cadillac, so maybe this isn't all over, so we'll see.
Maybe to Ferrari?
Maybe. We'll see.
Would you like that?
I would like to win. That's what I'd like to happen at Ferrari, okay?
Okay, all right.
All right.
Duly noted.
Those wins are deep. Up next on the programme, taking aim at copper and pharma.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. They're going to be tariffed at a very, very high rate, like 200%.
Up next, we'll catch up with the former senior Trump trade advisor, Kellyanne Shaw.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? Now, the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The president yesterday, tariffs will start being paid on August 1, 2025, and no extensions will be granted. This market didn't even blink. Equity futures positive by 0.2% this morning. On the Nasdaq, up another 0.21. Under surveillance this morning, taking game at copper and pharma.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that, they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
Here's the latest this morning. President Trump vowing to push forward with copper tariffs and giving the pharmaceutical industry a year before slapping a potential levy of 200%. Joining us now to discuss, the former Trump trade advisor, Kellyanne Shaw. Kellyanne, good to see you.
Good to see you.
I'm sure you've been up all night. What's the advice to clients?
My advice to clients is to take the day off, see how this plays out, and then come back in 2 days and a week and see what the tariff landscape looks like. Because right now, this is the end game of a massive, massive negotiation, and there's just as mixed substance as there is theater. So if you're making real business decisions, you're best just taking a beat and waiting it out and see where things land.
Having worked for Trump, is this the final moment where he's trying to extract the most concessions from all these countries?
I think that there is a lot of that in this. And what's so challenging about watching Trump from the outside and what makes him such an interesting negotiator is that there's just as much mix of substance as tactics. And so trying to understand the forest through the trees can be very difficult. But I do think this is the end game. And I think he's trying to say, okay, country X, country Y, you've given me this deal, but are you really going to give me more? And that's what he's trying to get.
Who is the White House most focused on right now?
In terms of the foreign trading partners. So they've talked about these 18 countries. We've heard anywhere from 18 to 30 important trading partners. I think those are the ones that the administration's really focused on trying to land a deal with.
You think this is the end game so that we're going to get some clarity on August 1st? Is that what you're telling clients, that essentially this isn't just a deadline and it's going to be moved to September 4th and then October 1st and then on and on?
Well, both, right? So at the same time as we do have this August 1st deadline, and the president doubled down yesterday on True Social and said, no, this is a firm deadline. They have also said that if you don't like your tariff rate 6 months, a year, 2 years from now, you can come back and try to lower that through negotiations. So I think we'll certainly see more certainty, and I'm actually hopeful that we do well in advance of August 1st because Customs needs time to adjust the HTS, give importers notice of what those tariff rates are, and that process alone can take a couple of weeks.
I just wonder how much some of this leverage is getting lost in the increasingly extreme rates and the increasingly extreme tactics. Does that actually end up bearing less fruit after using it many times? And that's sort of the question that you see in markets is a lot of people shrug this off. And frankly, some of the rhetoric that we're hearing from the trading partners saying the same thing.
Well, I think I'm hearing different things from trading partners, anywhere from sheer panic to blasé in terms of some of these tariff rates that have been announced. But what I would say is this is very typical of President Trump's approach to negotiations. And I do think that tariffs will go up. The question for me is by how much and with respect to what trading partner. And so, whether this is the boy who cried wolf, I don't think so at all. I do think that the tariff rates are going to go up, but are they going to go up to 36% on Indonesia? Are they going to go up to 40% on Myanmar? Maybe not. Let's see where things land.
What I'm hearing from you is that his tactics are actually working on the other side of the negotiating table. Would you say that's correct?
Yeah. Having talked to a number of trading partners, there is a bit of let's pick up the phone, find out what's going on, and see how we can de-escalate this happening.
Now, when he comes out and announces something, maybe for India, because he said he basically signaled that yesterday, I had heard that this was imminent. Is it going to be a framework like he announced with the United Kingdom, or we get more substance and details to it?
So India is a bit different than some of the other negotiations that are happening. This is more like a broader trade agreement. So I expect the deal with India to be about a subset of issues. Versus these reciprocal deals, I do think will look more like frameworks with the substance of those provisions and the details to be negotiated moving forward.
Just one point, one dimension of this that I think we will find really interesting is transshipping. How much progress have they actually made so far to stop the flow of trade going from China through other countries and into the United States?
Well, this is an active debate in Washington right now. What does that word transshipment mean? Does that really mean ships that are going from China to a third country like Vietnam and then to the United States? Or is it a reference to this concept of a rule of origin? Meaning if you've got Chinese content in that supply chain, you're going to be paying that 40%, that higher tariff. And if that's the case, Vietnam's between a rock and a hard place, as are many of these countries, because China does not like that idea or that provision. So we'll have to see what the administration means by that when we see the actual text.
Outside of Vietnam, what are the countries you're tracking on that issue?
So the president has had the transshipment issue in every single letter that he sent out. So Japan and Korea have it. I think this means a lot for Southeast Asia because so many companies moved supply chains after the original 301 tariffs and Trump 1.0. So this could really hit them.
Kellyanne, appreciate it. It's good to see you in person too, here in New York. Thank you. The former senior Trump trade advisor, Kellyanne Shaw, on the difficulties of making some deals right now.
Well, it sounds like what Kellyanne's saying is that this is the end in terms of trying to get to the finish line, which is why you see the president exerting all this pressure and telling clients, take 48 hours. We're not done yet. Take 48 hours, then come back, and you'll see maybe a little bit more clarity.
We'll all take the beginning of the end and not the end of the beginning, right?
I think that's...
I think we'll all take
yes,
that.
I think people would like this to be the beginning of some more certainty because we're all sick of saying the word uncertainty, and so we'd like to move on to another topic.
August 1, are we moving on?
No, absolutely
I
not.
thought we were moving on July 9th. I was hoping.
Did you actually think so?
I was hoping we'd just get a number across the board, universal tariff. Not that my view matters much, but a universal tariff, and then just move on.
Yeah,
just move on and pick up on what Savita said over at Bank of America. Corporations will adjust to this. They're resilient. They'll work it out, and they'll move on too.
2 points. Companies are resilient, and they are going to move on. But as far as the uncertainty, well, hope is not a strategy because that seems like it's an ongoing
And we
policy.
just had an entire trade discussion without talking about China. That is something that cloud is going to overhang this administration much of next year as well, because they only are dealing with 2 issues right now. We haven't even gotten to the purchase agreement of Trump's first administration.
Hope is my strategy, all right?
Oh, that's
I'm
so
getting through
sweet.
life. Hope, that's all you can have. Faith.
Yeah, I think you need a letter
Faith
for
in
that.
your fellow human beings.
Oh, okay. You write a letter on that. I'll write you my letter.
Up next, John Bilton of JP Morgan Asset Management, Sucharita Kadali of Forrester, Nancy Lazar of Piper Sandler, Leslie Falconio of UBS. Put it in the complaint box, right?
Well, the hope is my strategy.
You've got to tell us about that.
Well, I think it's a very good strategy.
You've got a complaint box at home.
Yeah.
And it comes out once a month.
Once a week.
Once a week?
Yeah, so
Man,
don't
a lot of
tell me my
complaints.
complaints. Just file it in the complaint box. We'll discuss it Saturday morning.
And do you discuss it?
Yes, it's
Kind
betting.
of. And then burn them.
And then, yeah, and then in the incinerator.
Why is Baltimore so important to you? It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's still a moving target with the tariffs.
Even the trade deals that are struck, they're still not very detailed.
We're at really high tariff rates right now. In our minds, the next signal points upward.
There's still a lot of story to be told. There's still a lot of negotiations to go on.
It's not a pretty thing to watch, but I think the markets have figured out that this is going to get resolved in the next few months.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell stateside, live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P positive by 0.2%, continuing to shake off the trade threats from the President of the United States. The Nasdaq 100 up by 0.2. If you check out the bond market, the focus is on a 10-year maturity. Yields higher for a sixth consecutive session. Your yield this morning, 441.52. Your day ahead, dominated by a bond auction later on this afternoon at 1 p.m. Eastern Time.
Which will really give us a sense of just how much demand there is for that 10-year maturity at a time where there are real questions around the U.S. fiscal dominance, as well as just this ongoing question around the Federal Reserve Chair. And this is why it matters. We've been talking about it extensively. If the Fed appears pressured to lower interest rates, not based on economic data, but in order to lower interest expenses for the United States, that could cause an exodus from the long end, and that on the margins is starting to be the conversation.
BlackRock's Jean Bavin believes this bond market is still a constraint around this White House and their policy on trade. And there's only so much they can push the dial when it comes to tariffs, because this bond market might start pushing back big time.
Well, we saw that on April 9th. Remember when the bond market, to the president's words, got, quote, yippy, and they had to reverse some of the policies when it comes to Liberation Day rates. But we just saw Liberation Day rates once again from this administration, and the market pretty much shrugged it off because they are tempting the president, I think basically saying, boy who cried wolf, you're not going to go through with this. Kellyanne Shaw, though, who was a negotiator under Trump during 1.0, makes a very good point. A lot of theaters going on right now. What the president is trying to do in the final negotiation is push people to the edge. When I say people, other trading partners. And because of that, he wants to get as many concessions as he can. And while the market might be shrugging it off, if you are a prime minister in one of these other countries, you're still second guessing whether or not he means it or not. So you're picking up the phone.
I don't think Kellyanne will mind us saying this. She came into the studio about 15 minutes ago, walked in off mic and just said, take a day off, grab a beer, and wait.
Try to get some more clarity. 48 hours. I said, is 48 hours enough? She's like, maybe a week. This is sort of the moment at which we're in narrative roulette zone. We're trying to understand what the roulette of tariffs is going to look like. We're trying to understand the roulette of what earnings are going to look like when they kick off. Tomorrow we get Delta, next week we get the banks. And the roulette of just what the Fed will do at a time when they're being jawboned. And so we're trying to pick up on these strains at just a time of throwing up the cards, and let's see what happens.
Equities are pretty comfortable with all of this at the moment, close to all-time highs, up on the 0.2% this morning. Mentioned this earlier on this morning in the first hour of this program. Mark Zuckerberg's not freaking out about trade and tariffs. He's going around hiring people at $10 million apiece. What does that tell you about what he's focused on and what's really driving this equity market?
It shows how much the AI trade has still been underpinning so much of this. And that really is at the core of this. And yesterday we were having this conversation where how sensitive are the AI trades to tariffs, to this idea of these levies being put on? And the answer is right now, not very, because that is the future. And if that's the case, you've got price-insensitive buyers when it comes to some of the hyperscalers, particularly with NVIDIA and some of the other chip providers.
Nasdaq futures this morning high by close to 0.2%. Coming up this hour, we'll catch up with John Bilton of JP Morgan Asset Management as uncertainty limits investor confidence. Sucharita Gadali of Forrester on signs Amazon's Prime Day is disappointing. And Nancy Lazar of Piper Sandler as the pressure builds on Fed chair Jay Powell. We begin this hour with Stock Steady as investors digest the president's latest tariff plans. John Bilton of JP Morgan Asset Management writing, uncertainty around policy impacts has crimped investor and business confidence, contributing to a likely dip in activity in the second half of 2025. John joins us now for more. John, good morning.
Good morning.
How convinced are you by the slowdown in the second half and why?
Well, I think we've got to look at it economically. We've had a lot thrown at the market. You've got investors who've sort of sat back and wanted to stay on the sidelines, and especially corporations. And we're seeing that come through. Things like the jobs report, it was okay, but it wasn't suddenly sort of taking off. The turbochargers really weren't kicking in at this stage. And we think that we're going through a period where the market is adjusting to the data, the soft data that's come through. And you'll see that leak into the hard data. But make no mistake, if we look beyond the second half, what I think has surprised everybody, ourselves included, is the sheer resilience of the US corporate sector. And as we look ahead into 2026, which is what we think the markets are doing, actually the prognosis is generally better. But it doesn't preclude us having that period of a little bit softer economic activity in the second half.
This is always a challenging call. Can you price the recovery to the slowdown we haven't had yet? Can you do that?
I think what you've got to do is look through it. This is the really key point. If you want to day trade around it, I think you're missing the point. Right now, we've got a corporate sector which has absorbed a lot in terms of the tariff shocks. I think the reason that April 2nd was such a shock was suddenly everyone went, goodness me, he meant what he said. We've got tariffs suddenly have gone from 2.5% to 25%. The reason the markets looked through the copper issues, I think, is if you actually run the numbers, because of the 17 billion of imports that the US has of copper and the significant amount that it self-sources, actually it's about 0.2% impact on the effective tariff rate. And this is a market where we already know that these are coming in somewhere in the middle teens. So the markets have, to my mind, moved on from this. They're looking at the dominance of the tech sector. They're looking at the AI trade. In fact, our quant analytics suggest that the biggest driver of equities this quarter has actually been the AI theme, not the tariff theme. And that's why I think we're making all-time highs.
And this is the reason why so many people have come on this program and said that they like U.S. equities, they don't like U.S. debt. They like U.S. equities, but they're worried about the dollar. There still is exceptionalism. It's just in a smaller pocket, and it has to do with AI. Are you a believer in that?
Well, I think you've got to unpack U.S. exceptionalism. And so there's one level of U.S. exceptionalism which I think is probably acceptable to the administration, and that's the dollar giving up some of its excessive valuation. We've heard chatter about, concern around currency manipulation. It's never really gone away. But with the dollar weakening, because there's just simply less demand for it, that's taking that issue away. But we're seeing very little evidence of this idea that the dollar is ceasing to be king dollar, the reserve currency. I mean, 40% of global trade is invoiced in dollars, even though the US is a counterpart in only 10%. So, and the institutional strength of the US compared with other regions is still paramount. So you'd need to attack both of those bases before you'd start to unwind the dollar. As for stocks, look, if we unpack the S&P 500, the tech giants continue to be global leaders on relatively decent valuations with strong earnings. The rest of the S&P, actually, it's getting up towards quite peaky valuations. So we do look outside. We look for diversification. Hong Kong, emerging markets, the UK, and Europe's beginning to look really interesting given the fiscal thrust that's coming next year and the fact that what we're also seeing is the ECB be able to respond with much easier monetary policy because of the disinflationary impulse that tariffs create for the rest of the world ex-US.
So how do you play that? Jean Bovin, BlackRock, was on earlier, and he said that he liked European bonds versus U.S. government bonds, not so much European stocks relative to those in the U.S. Do you agree? I mean, do you prefer European bonds to the U.S. ones because of the ECB's proclivities to possibly cut rates, even in the face of that fiscal expenditure?
Well, so we do continue to like European bonds in preference to the U.S. for the reasons that we think that what's happened with tariffs and all the chatter about national security has actually forged a common purpose for Europe that we've really not seen for some time. And so the spending that's happening, if you look at what's happening with Germany's spending, by the middle of the 2030s, it only takes German debt to GDP to around about 80%. The European Union, particularly Germany, have massive fiscal headroom. And we've got the disinflationary impulse. We've got Europe pointing in the same direction generally now. So it means, some of the periphery markets, the Spanish market, the Italian market, etc., look particularly interesting as a place to pick up carry, pick up some decent returns there. But I wouldn't write off European equities right now. Yes, they're a little bit more expensive. But if I told you at the beginning of the year, you know what? We're going to see European earnings expectations for 2025 go from 8% to 1%. What would you think the market would have done? You wouldn't expect it to have been up 10% year to date. The market now is pricing a very shallow forward earnings curve just at a time when we're about to see a significant fiscal and monetary boost. So we're beginning to get quite excited about the European asset market in general, but certainly leading off with the bond market.
But aren't European equities going to be the most exposed when it comes to the tariff risks?
Well, I think what we've already seen is that's been priced through the earnings forwards. So we have got Europe trading at around about 15 times forward multiples, which is significant premium to where it's been over the last 10 to 15 years, albeit that was a period when Europe was resetting its balance sheet with regard to the bank's post-Eurozone crisis. So yes, there's a lot of tariff potential impact, but we also have one of the most powerful negotiators out there, the European Union. And so I do think that some of the saber rattling that we're seeing from the White House should be taken seriously in terms of thinking what it means for Europe. But make no mistake, Europe are incentivized to come to an agreement and move forward. But what it's also doing is it's forcing Europe to look inwards. It's the biggest consumer market on the planet. It's twice the size in individuals of the United States. And we're beginning to see self-help, fiscal spending, monetary support, and as a result, I think what we can see is a little bit more potential for Europe to play catch-up.
You laughing at the Europeans?
Well, it's self-help. Chicken soup for the European soul. I just picture this. There's nothing quite like having a common enemy. That's all I can say.
They need it. Right now, they've got to eat Chinese deflation. I was looking at PPI out of China overnight, the 33rd month of negative factory prices out of that country.
Overproduction, overproduction, and where is it going to go? And that's really a question, and that's part of the reason why the ECB may have the ability and desire to cut rates.
The ECB doesn't look comfortable right now. I have to say that. Listening to the officials in the last week or so, you make it sound quite straightforward. I agree with you, it should be. But that's not what I'm hearing. They're worried about the FX channel and then doing nothing about it.
But look at it in terms of euro-dollar versus trade-weighted euro. Excuse me. Euro-dollar has moved around 12, 13%, so that's significant for that currency pair. But of course, in trade-weighted terms, the euro's moved around 7%. So meaningful, but bear in mind that the bilateral trade with the US, while clearly important to Europe, is not the only barometer that they look at. We're just beginning to see a little bit of nervousness coming out in terms of some of the commentary from Sintra around the level of the euro, but I don't think this is in any way panic stations yet. And if anything, when we look at it against our long-term fair value, again, going back to euro-dollar, we see fair value somewhere around 125. So pushing up to the upper teens, perhaps the 120 level this year, I don't think is going to scare the horses at the ECB too much.
John, it's good to see you.
Good to see you.
As always, thanks for dropping by, and thanks for trying to explain what Charlton Athletic is to Anne-Marie in the commercial break. Good attempt. John Bilton there of JP Morgan Asset Management. What did you say? That's not a real football club?
Well, it sounds a little bit like a Mickey Mouse football club.
Okay. Hope Charlton's not listening this morning. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
From a Charlton fan, John, not happy about that. Here's your news, though. Investigations are underway in the deadly Texas flash flood. They're looking into when weather forecasters advised local officials about flooding and what those officials did to spread the message to thousands in the area. The floods killed over 100 people and 161 are still missing. Elsewhere, the Supreme Court gave President Trump approval to cut the size of the federal government. The decision lifted a court order that blocked federal departments and agencies from slashing their workforces. The coalition of federal employees, non-profits and local governments said that the decision, quote, dealt a serious blow to our democracy. And finally, US consumer borrowing increased in May at the slowest pace in 3 months. Federal Reserve data shows credit card and other revolving debt outstanding declined $3.5 billion, the first decrease since November. Non-revolving debt, such as loans for vehicle purchases and school tuition, increased $8.6 billion. That's your Bloomberg Brief. John.
Lizzie, I had no idea. I apologise on behalf of the programme. Up next, the Morning Calls Plus. Sucharika Kadali of Forrester on signs Amazon's Prime Day is set to disappoint. Their conversations next. So live from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
So here's the runway for the next month or so. July 15th, CPI. 2 days later, retail sales. Go on to July 30th, a Fed decision. 2 days later, August 1 payrolls the same day for the next trade deadline. A lot still to come over the next few weeks. Equity futures at the moment grinding higher into it, up 0.2% on the S&P. On the Nasdaq, up by 0.2% also. That's the price action. Here are your morning calls. First up, Oppenheimer upgrading Microsoft to outperform, seeing the company as one of the long-term AI winners in software. That stock is up by 0.75%. Your second call from Barclays, raising its price target on Netflix to 1,100, writing legacy media earnings could surprise to the upside. And finally, Citi raising its price target on UBS to 127, seeing balanced risk-reward for transport stocks due to a still soft demand backdrop. The stock is positive by 0.6%. Let's stick with the consumer. Amazon seeing a sluggish start to its annual Prime Day sale, with sales falling almost 14% in the event's first few hours compared to last year. Bloomberg's Poonam Gaur joins us now for more. Poonam, welcome to the program. I think our first question, our only question really, is whether this is an Amazon problem or a consumer issue.
I think it's a little bit of both, but you have to remember that the event is 4 days this year, not 2 days. So consumers have time to come out and spend.
Does brand Jeff Bezos and the recent wedding dent the enthusiasm over brand Amazon, Poonam? Do you see any of that at all?
I think consumers are looking for deals right now, and Amazon's providing the deals. So I think most will just focus on the deals and their budgets to maximize them, which Amazon and other retailers are providing them to do this week.
What's tickled you?
Well, I think there's just funny because I do now think of Amazon. I'm a little bit like, oh, is it a little tacky?
Based on the wedding?
Based on the wedding, yeah.
Okay.
Also, the
That's your
deals.
association with
Also,
them now.
the deals. They're saying these deals for the AirPods are supposed to be the best, but if you Google them, you can get the same exact price on Walmart, and they're not having some special Walmart day. So I don't really know if there's real deals to be had.
Poonam, we saw plenty of pull forward in the first few months of the year. The threat of tariffs hanging over the consumer. There is an open question as to whether we've worked through a lot of that pre-tariff inventory. How much inventory is left?
I think there's very little pre-tariff inventory left. As far as what I'm seeing and what I'm hearing from retailers is that 2Q deliveries have the tariff rate built into them. And as the rates are subject to change over the next 2 quarters, especially holiday, prices could rise even further. So deals still matter, and they still matter a lot. I'd say, we'll know a little more in the next day or two. I did see data this morning from Numerator, which basically said the first 16 hours of Prime Day, the average order size was a little over $58. And if you compare that to last year, the first basically more than 30 hours, the average spend was over $60. So there is a deceleration, but I'd say there's still time for people to come and shop.
Poonam, appreciate your time. As always, Poonam Gaur there of Bloomberg Intelligence. To extend the conversation, Sucharita Kadali of Forrester writing, retailers will be more cautious about discounting too early in the year should there be supply chain issues or heavier hitting tariffs. Joining us now, Sucharita. Sucharita, let's just talk about the tariffs so far and pick up on that last question that we asked Poonam Gaur. The amount of pre-tariff inventory there is still at these retailers for them to work through, or are we getting to the point where they've got to make a bigger decision?
Well, there are so many factors to consider with tariffs and the amount of inventory that you're going to hold, because retailers just don't have an infinite amount of cash on hand that they can invest their working capital in this inventory that they want to front load. So it is a balance between front loading the things that you know are definitely going to sell and are not perishable and will be able to have some shelf life, while also maintaining the reality of how much you're likely to do in sales. If retailers pull forward too much inventory, what they end up doing is that they're risking cash flow, and ultimately the lack of cash flow is what drives retailers to bankruptcy.
So, Trita, if you put this all together, what does it say about the prospect for deals? We were looking through Amazon for deals and not finding as many as we have in the past. That doesn't speak of desperation to clear the shelves of any existing inventory.
My hunch is that marketplace sellers were probably a little bit more cautious with what they were able to offer Amazon in the first place. Amazon works by everything that sellers have shared with us. They work long in advance to get the deals, and what has likely happened is that tariffs earlier this year threw a wrench into things. And as a result of that, we just saw prices likely going up, not substantially, but enough that you wouldn't necessarily see the great deals that you'd see otherwise. So it's not surprising that likely there are more categories that are now offered for sale. We certainly are seeing a greater number of days. And over the last few years, we've seen multiple Prime Days. Amazon now runs this event twice a year. They have it in July and October, in large part to be able to comp the previous year's numbers.
Which really goes to the point of how much can we really gauge or extrapolate out consumer demand from these numbers at a time where I know that in my household every day is Amazon Day, and it's sort of how many things can you possibly buy? I just wonder, is that sort of your read-through? Is that both the sellers aren't really offering amazing deals, they're kind of not buying into it quite as much, and the buyers aren't rushing to front load their orders because they can do it at any time? Is that kind of what we're seeing? And it kind of takes the winds out of the sails of people who say this indicates that consumers are falling off a cliff.
Right. I think that what you've just suggested, which is the truth, is that consumers are honestly a little bit jaded by some of these offers that are out there. So there's the combination of the fact that they are not as excited. And by the way, when you have multiple types of offers over multiple days, we've even seen sort of the drop-off happening around Black Friday and some of those key dates that historically during the holiday season were big selling dates. But as you add more, as more retailers have more products for sale, it's just not as special anymore. So you have the jaded shopper, and then on top of that, we have all of the economic issues, the consumer confidence issues, and the fact that that we did front load a lot of transactions in Q1 and Q2. Retail continues to be fairly resilient, and a large part of that was the pull forward that we saw earlier this year due to the threat of tariffs.
So, Trita, you mentioned in your note later in the year where there could be supply chain issues. What kind of supply chain issues are you starting to think about potentially that some of these retailers could be hit with?
Well, it's really if there are ultimately some of the tariff discussions do actually come into place. So a lot of what has happened has been the threat of tariffs. There are some regions of the world, some product categories that are facing higher costs, like in China. But for other parts of the world, there's essentially been a moratorium. But that led to a lot of uncertainty and a lot of concerns around, well, let's get ahead of this and let's pull forward whatever we can, both from a consumer standpoint as well as a merchandiser standpoint for wherever that was possible. Now, we are coming up to the 90-day limit, and what we may see is the resumption of some of those threats of tariffs, even in regions in the world where we hadn't seen them before. So other parts of the Far East or India or even products coming from Europe. So in that case, in that scenario, you're absolutely going to see either higher prices, which will lead to inflation, or you're going to see just lower inventory availability because the retailer is simply going to be buying to what is absolutely essential and not have any excess inventory in stock.
Sucharita, great to get your thoughts. Sucharita Kodali there at Forrester, the latest on Amazon Prime Day and what retailers are doing. It's a process, and that process is continuing. They had to work through a lot of pre-tariff inventory, and then we can figure out how much they're going to take on margin. Once we figure out how much they're going to take on margin, you can start to do some sums about what it could mean for cost cutting elsewhere, including the labor market, and that might be months and months down the road still from here.
So if you're looking for clarity, maybe hope can be your strategy, but right now it doesn't seem like that's the case. As we were talking, I got an Amazon Prime email tailored for me.
Finally, what'd you get?
With some specific deals, 25% off socks, 32% off handheld steamers, 45% against hand exercisers. This is the kind of stuff I'm revealing way too much about myself. Yeah, exactly.
What bears like.
Yeah, gold bars.
Yeah, exactly.
Yeah, exactly.
Yeah.
That's
that long life coffee and all of that stuff.
Yeah, there's emergency packs that you put in.
You've seen those preppers.
Yeah, totally. That's what I'm saying.
Yeah, I find that fascinating.
What are those meals called? Where it's sort of like the forever bar that you can eat that can give you some sustenance?
I forget, but they're pretty gross.
Have you tried them?
No, I don't want to either.
Okay.
Let's hope we're never in the circumstances where we have to eat that stuff, all right? Coming up on the program, Nancy Lazare of Piper Sandler as the pressure builds on Fed Chair Jay Powell, plus Yahira Anand with your morning movers, and a big deal for Big Pharma. Live from New York, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The open about 16 minutes away. Equity futures positive by 0.2%. A struggle to bounce back from Monday's trade-related losses, but a mild day of losses in yesterday's session. A small bounce on the Nasdaq 100 up by 0.2. In the bond market, 2-year, 10-year and 30-year. A focus at the front end of the curve and the big Fed debate. Yields higher by a single basis point at 390.32. Further out along the curve, a big conversation about the prospect of inflation firming, plus what could it mean if you get a Fed chair that comes along and does exactly what the president wants long before the data demands it? Will that contribute to higher long-end yields? This morning, 441.52, yields higher for a 6th consecutive session. We're higher by another 2 basis points. That's the cross-asset price action. Let's cross over to Yahira Arnott for some single names. Hey, Yahira.
Good morning, John. We start with some big news in the pharma space, some deal news that we did talk about earlier, but now it's official. Merck has agreed to buy the UK biotech Verona Pharma for about $10 billion. So as a result, take a look at Verona Pharma. It is up more than 20%, and it's a strategic bet for Merck on respiratory medicine at a time when it's trying to diversify. That's because its top-selling cancer drug, the patent on its top-selling cancer drug is expiring soon, so it is looking for ways to offset that. Next up, we have a really big mover in our X-Site. Shares are down nearly 50% now. That's because the company, which makes lenses used in cataract surgery, slashed its 2025 forecast by $55 million. A big shock to investors, as you can see, and it's spurring a number of downgrades this morning. And we end on Starbucks, rising 3% now on our reporting that the company is considering selling a bigger stake in its China business. That's a shift since Starbucks had originally planned to keep a tight grip by only selling a minority stake. But with sales struggling and competition heating up in its second biggest market, we're reporting that it is sifting through offers and narrowing down a list of potential investors to try and make a deal. John?
Yahira, thank you. Thanks for this morning. Appreciate it. Let's get to the day ahead. It looks like this. Fed minutes later on this afternoon, another Treasury auction at 1 p.m. Eastern Time. $39 billion of 10-year notes. With the latest, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. I think today probably the Fed minutes will get some attention, but given the fact that the president is going to be releasing more tariff letters today, by the time we get to the Fed's discussion of what they were thinking 3 weeks ago, it may be mostly irrelevant, although people will be looking to see what the discussion was about why they kept 2 rate cuts in the forecast for the year. Now, as far as the 10-year, the question has been, are we going to see some sort of buyer's strike by people from overseas who are unhappy with the United States? And the general feeling on Wall Street seems to be not yet, that there's enough demand out there. There might be a little supply concession, but overall, there's still demand for 10s. And any real movement based on what the president is saying about Jay Powell and others would really occur at the 2-year level for the moment.
Mike, any thoughts on the Fed race? Kevin Walsh versus Kevin Hassett, and whether we're seeing some auditioning already on the FOMC?
Well, I think there's been auditioning, definitely auditioning. I think that Kevin Walsh is probably the favorite still. Kevin Hassett, very loyal and probably seen as the guy who would push for lowest rates. But what kind of reception would he get on Wall Street? That's something that Scott Bessent is going to be have to be weighing when he gives advice to the president about this, assuming that Mr. Bessent isn't putting himself forward. And then the question that they keep raising is, what if Jay Powell doesn't quit as a governor? They would only have 1 seat. They'd have to put the new chair into the seat that comes up in January. And so does that mean that maybe they keep Chris Waller in reserve just in case they can't get somebody else?
This could get messy. Mike McKee, appreciate the update. Looking forward to your reporting throughout the day. Michael McKee there from Jackson, I believe. over at an economic forum over there?
Yeah, they do a lot of economic forums in Jackson, Wyoming, evidently.
Why not? It's any excuse, right?
You know, can we just separate out the drama and have that sort of like, you can watch the melodrama if you want to, but then watch paint dry over here, which is the actual policy, which is going to depend on all this economic data that's going to come through the fore. I think that would be great. You know,
do that right now.
Okay, cool.
If you want. Nancy Lazar of Piper Sandler with this to say. Investors might be done with tariffs, but we doubt Trump's tariff agenda is done with investors. Nancy joins us now for more. Nancy, good morning.
Good morning.
What is guiding you at the moment? What convinces you of that?
Well, to be sure, this administration wants higher tariffs. They've already put in higher tariffs, and they're going to stick. We've accepted the fact that tariffs are here to stay. Why? We do need a freer trade backdrop. And two, I think misguided, this administration thinks this is positive for the United States. I'm a free market economist. Tariffs are a bad idea. Nonetheless, I have to accept that they are indeed here. And they're going to be a negative impact on the economy. It's a regressive tax on consumers. Lower-end consumers are going to get hit more because of these higher prices. And same for small and medium-sized businesses. Larger businesses might be able to plow through this, but the smaller, medium-sized part of the economy are going to get squeezed from these higher prices.
When you take the politics out of it, is this more inflationary or more of a slowing growth type of ramification from the tariffs?
Well, near term, it's a tax. It's a hit on the economy. Whether or not it turns into sustained inflation depends upon what both monetary and fiscal policy do. I would worry about the Fed stepping in and cutting rates too aggressively here, because that would just increase the odds that these price levels indeed stick. When you've seen tariffs before, when we had some back in 2018, it was a price shock. You saw it in furniture, household appliances. You initially had that increase in price, but then you had a decline in demand, and that eventually led to a lower prices actually for household appliances and furniture. So it depends how sustainable these are on what the Fed does.
I want to just hone in on something that you said. If the Fed cuts, you think that that would lead to more protracted price increases and more sort of entrenched inflation. What gives you the confidence to say that at a time where we're seeing on the margin some slowing in consumer spending and certainly deterioration in consumer confidence?
Well, as we saw, and this is nowhere near as extreme as we saw during the COVID crisis, you can have a temporary shift down in demand, but inflation is a function of what the Federal Reserve does, monetary and fiscal policy does. So even though you had that shift down in demand in 2020, because both monetary and fiscal policy eased so aggressively, you then net had price levels stayed elevated with that supply chain disruption, and then you had the inflation in 21 into 22. So near term, yes, we are having a shift down in demand. Which could lead to lower prices, say, later this year, next year. But if the Fed were to cut rates too aggressively, then I would, again, be worried about inflation in 2026. And I thought your point on the bond market here is going to be really important. The Fed cut rates last year, 100 basis points. Everyone seems to forget about that. They cut rates 100 basis points in the fall of last year. What did bond yields do? They rose 100 basis points. So the Fed controls the short end of the curve, and I think some of the administration understands that, but they have to be careful of the long end.
Will the Fed have enough information to cut by September, given the fact, especially that the tariff deadline has been pushed out to August 1st?
I worry about that because we saw that the employment report on the surface looked healthy. Underneath the hood, it was actually a weak employment report, but on the surface, it looked healthy. I would have thought it would have been easier for the Fed actually to have cut rates here in July, where you really still have tame inflation and signs of an economic slowdown. I worry by September. You could have maybe clearer signs of a weaker economy, but stickier inflation. I am hearing from retailers that they're done with inventories. The pre-tariff increase in inventories, they're fading. Now they are going to be selling these higher price products in the third quarter related to the tariff increases. So I worry about September.
But a cycle or one price adjustment?
Again, for right now, it's a one price shift up in price, as we saw in 2018, but we don't have the conclusion. It depends upon how aggressive the Fed is.
When you say you're worried about September, are you worried about the price side of things Or are you worried about what could happen to the labour market if they have to absorb some of this on margin?
Well, I think you're going to increasingly hear stagflation as you go through the third quarter, because already you're seeing consumer spending stalling out. Already, again, under the hood, the labour market is deteriorating. Unemployment claims are probably the easiest number to show that, cleanest number to show that. So I worry that as you go through the third quarter, the Fed is going to have to really balance it. On one hand, you will have a weaker economy. GDP growth, we have less than 1% in the third quarter, probably a higher unemployment rate. But then the inflation data could be also more sticky, and you're seeing it in the data. Shelter was a headwind to inflation in the second quarter. Is that going to continue into the third quarter as these tariffs make their way through into the data?
And that's, as you know, there's a range of views at the Federal Reserve. This FOMC is incredibly divided. One view, I think is quite important at the moment, is Governor Waller's view. And Governor Waller is making, I think, a credible argument to say you should look through the inflationary effects, potentially of tariffs, and maybe think about reducing interest rates. Do you find that particularly compelling?
I don't. One, I think if you look through the tariffs in aggregate, the economy actually is on a healthier footing. This is a soft patch. Volatility created from the uncertainty and the tariff and the price increases. As I've said before, and I focus a lot on capital spending, you have incremental fiscal stimulus for 2026, importantly for capital spending, which has boosted potential GDP growth already. You don't need a lower interest rate environment. As some of you have reported this morning, there's a lot of liquidity in the markets. That's why this M&A cycle is picking up. And I would be leery in cutting rates too aggressively. One, the economy is healthy with stronger potential GDP growth. We have basically a 4% unemployment rate. Cyclically, it's going to go up a little bit, but we don't need lower interest rates. This is not 2008-9. It's not a COVID crisis. I think rates should stay where they are.
So, John, I was thinking as Nancy was talking, if you wanted to explain stagflation, there is one economist, Donald Trump, who really put it perfectly when he said just a few months ago, maybe you need just $2 that cost a little bit more rather than 30. And maybe that's what we're seeing trickle out into the economy.
Is that the argument he's making now?
I don't know if he really wants to go back to that.
Quite the same thing.
Maybe not. I do wonder, though, about where the inflation comes from. If you do see consumers in not as strong of a position, you pointed to the labor market and the weakening that we're seeing in certainly the private payrolls report. Where is it going to come from in terms of fueling the ongoing ability to absorb the price increases?
So it will have to come from stronger corporate profits. I mean, because if you have a stronger corporate profit backdrop, then you'll get a stronger labor market, you'll get bigger wage increases. And so near-term profits are under pressure. 2Q earnings are probably going to decline, not year over year, but sequentially, which is why you have this weaker labor market. So you need this soft patch to end, which we think can end on its own without lower rates in 2026. Because of this incremental fiscal, and importantly, because of the capital spending cycle. And so the investment cycle fuels productivity, productivity fuels profitability, and that is how you get a stronger job market.
Nancy, we hope you're right. It's good to see you.
Thanks for your time.
Thanks for dropping by. Thanks for your time. Nancy Lazar of Piper Sandler. Equities at the moment positive by about 0.2% on the S&P, with an update on stories elsewhere with your morning brief. Your Bloomberg brief. Here is Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump said he will push forward with a 50% tariff on imports of copper into the US. The announcement sent copper prices plunging in the global benchmark. Trump is looking to spur more mining and smelting stateside, and the tariff can be in place within weeks. Elsewhere, a leadership shakeup at Apple. COO Jeff Williams is retiring from his post later this year, with plans to continue to oversee the design team and to manage health initiatives. 30-year Apple veteran Sabi Khan will replace Williams as COO. And Tesla CEO Elon Musk telling Wedbush analyst Dan Ives to, quote, shut up in a post on X. His comment coming in response to Dan's call for Tesla's board of directors to get involved after Musk unveiled his bid to start a new political party. And that's your Bloomberg Brief, John.
Lizzie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead, plus Leslie Falconio of UBS as investors face President Trump's latest tariff threat. From New York City, this is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Mild gains so far this morning, positive by 1/4% on the S&P, and the Nasdaq up by 0.2%. The day gets busier as the session grows older. Your day ahead looks a little something like this. 1 p.m. Eastern Time, the U.S. Treasury auctioning $39 billion in 10-year notes. 2 p.m., we get some Fed minutes. On Thursday, we'll get Delta earnings, so look out for that, alongside some jobless claims and another auction, this time 30-year notes. The focus on economic sentiment results from Delta Airlines tomorrow morning. Leslie Falconio of UBS writing the following. U.S. consumers and businesses increase spending in advance of actual and threatened tariff increases. That boost is now fading and will begin to drag on growth in the second half. Leslie joins us now for more. Leslie, thanks for joining us. Just to build on that particular quote there, where do you expect to see that show up and how soon?
Well, I mean, you know, we're expecting in the second half, probably not. I mean, obviously the GDP in the second quarter is going to be strong. We're going to start to see probably some slowing growth in, you know, the third and fourth quarters, simply as we've had a pull forward in both businesses, you know, and consumers. So our expectation is that the Fed does cut in September, you know, twice this year, but for a total of about 100 basis points. So we're looking for about 25 basis points consecutively each meeting starting in September.
Some debate at the moment between a lot of people as to whether they should price the recovery in 26 off the back of the rate cuts that we might see from September onwards, or the slowdown that you're forecasting for the second half. Which one?
Well, listen, I think it's a sequencing issue, right? I think people are focused on tariffs right now and the cost that tariffs will have in terms of consumer and, you know, therefore potential inflation. But in 2026, it's going to be more about tax cuts. So I think it's more about a sequencing issue. And if, in fact, you know, growth does slow, again, not collapse, we're expecting these non-recessionary cuts, and you have some stimulus in 2026, you could see an upward trend growth. And I think that's what the market's paying attention to.
One of the big challenges here is the inflation picture, and we're saying this ahead of next week's CPI report. I'm looking right now at five-year break-even rates, basically the expected inflation over the next 5 to 10 years as baked into derivatives. And it's actually at the highest level right now, going back to February. And I just wonder if the Fed has the bandwidth to cut rates the way that so many people are expecting, including yourself, given that there is this fear that is percolating into certainly markets, if not into what we're hearing from retailers.
You know, listen, there's no question, and you've talked about this before, and I happen to agree, if the Fed does cut prematurely, you do run the risk of that back end moving higher, and you have this really large bear steepener. But even though the five-year inflation might be up a little bit, it's still very well anchored. And when you look at some of the components of service inflation, I know we've been focused a lot on goods inflation, but if you look at some of the components of service inflation within, say, the CPI, OER year over year is down. Auto insurance year over year is down. So there are these service inflation components where you haven't seen this really large spike. But to your point, Lisa, it's definitely something that the market is going to be watching. And there's no question that market perception, if the Fed does cut too early, is going to react, before the actual fundamental data is shown. And that's really the risk that the Fed faces right now.
So at 1 p.m., we've got $39 billion of 10-year bonds being sold. And then tomorrow we have $22 billion of 30-year treasuries also being auctioned off. How closely are you watching the internals, the dynamics, to understand just exactly what the zeitgeist is in markets that could drive action and potentially even your strategy?
Yeah, I mean, look, we're watching the 10-year auctions today. We do expect some concessions. There's no question. It's not, just because we've had some, renewed tariff headlines and maybe this is, will increase inflation going forward. But a lot of this has to do with the fact that we had a strong jobs report. People came into that job report, I think, long duration, and they had to shed some. So I do think we are expecting some concession into the 10-year Treasury auction, but we still expect it to go well. And again, our, point on the curve since going back to 2024 has been to stay in the intermediate and that 5-year or the yield curve. And that's really worked out well for us. It's been a great hedge during those pockets of vulnerability in the equity market. It's had a great total return. And we're often asked, when would you extend? When would you move your duration out? Listen, it wouldn't be impossible or a small probability that we see the high of the 10-year Treasury yield that we saw in January around that 480. Would we start to extend and have that buy the dip mentality? We absolutely do, but we're not rushing in.
Well, what would make you get there, though? Like, what could be the catalyst?
In terms of rising rates?
Yes.
Yeah, I mean, listen, it could be, one, the Fed cuts prematurely. Two, obviously, this inflation that we're seeing turns out to be a bit higher than what we expect. And what I'm saying that it's not just having inflation come into the numbers, but how quickly it does, right? If it's this gradual rise in inflation, about 3.5% you still have to run a 3-month average about 4. So, I mean, in those kinds of, numbers, I think would really move those yields higher. I don't believe it's deficit driven. I've said this before on your show. I think, supply is a passenger, not a driver. It's about inflation and growth in that long end. But if you do see something that inflation's coming in faster, right, than what people are anticipating, then you could get it.
You said earlier the market right now is focused on tariffs, but next year it's going to be 2026 is going to be about the tax cuts. What tax cuts specifically? Because what we saw in the One Big Beautiful Bill in terms of the big chunk of the cuts, it's only an extension of the current policy we have today.
You're absolutely right. And I do think that, the market's perception of, I think, when we look at, especially if you look at 7% of deficit versus nominal GDP, if most of that GDP is already into the marketplace, and I agree with you, then I think what the market is looking at in terms of the benefit of terms of whether it's CapEx or the fact that it does believe that the Fed does cut, which should fuel growth. And I think that also no one expects third and fourth quarter growth to be, incredibly high. Even though we're looking at a 1.5% GDP in the fourth quarter, those third and fourth quarter numbers are going to be below trend. So I think you're going to have that upward slope in terms of that growth outlook in terms of 2026 as well. But that is the risk. There's no question.
Leslie, appreciate your time. Leslie Falconio there of UBS, looking ahead to a whole bunch of risks in the second half. Look at this right now. Peter Navarro, trade advisor to the President of the United States, saying Apple thinks it's too big to tariff. Apple just moments ago turning negative in the pre-market, down about 0.2%.
Yeah, this just points to the idea of you have to be in the good graces of this administration. If Apple was looking for a carve-out, Peter Navarro isn't the one that's going to give it to them, and they aren't going to be the one to really signal it either. I do wonder how much the president is going to pit himself against the tech giants that have gotten so much of the preeminence in U.S. equity.
And what's interesting is because everyone says India is going to be that deal that the president announced in terms of a framework that's imminent. What have we seen over the past few years when it comes to Apple moving supply chains out of China into India? Potentially, they're going to be hit with a rate that's going to make it very challenging for them. And Peter Navarro, he's not at the negotiating table, but he is very close to the president. He goes in and out of the West Wing, and he has the president's ear, and he's saying that maybe Apple is going to be one the president looks at next.
Apple is not having a good year so far. The stock is down by about 16%. Tariffs is one story. Meta going after their talent is another story. Here's one more. This from Peter Navarro. The Fed should cut rates. in July.
This is my shock face.
Who hasn't said that in this administration?
This is sort of the on-point message that you have to put out there. They're too late. It's too late, Powell. Not even too late, Powell. It's just too late. That's his name, TL. And, you know, he needs to go now. I guess there is a growing number of people in markets who agree with them. It's the argument that they make and how salient that will be, because if it is about the deficit and lowering costs, that is not going to resonate well with markets versus a discussion about slowing inflation and a lack of inflationary pressure coming from the labor market.
Neil Dutter of Renmac just moments ago saying that Trump has created a litmus test for his Fed nominee. They have to agree to cutting interest rates. This makes nearly all of the potential candidates look totally compromised. Went on to say this: if Trump values feeling the market, he may end up having no choice but to pick Governor Waller, an argument that Neil's made a few times.
You need the credibility in order for the Fed, to your point that you said earlier, to have the ability to cut rates, because ultimately it depends on that credibility that they will be willing to hike rates if there is a problem with inflation.
We've all said this repeatedly. There will be two votes, one at the Senate, and before it gets there, one in this market. And this market will vote very quickly about the credibility of whoever the candidate is. Coming up on the program tomorrow, the lineup looks like this: Liz Ann Saunders of Charles Schwab, Mike Zezas of Morgan Stanley, Holly O'Neill, the president of retail banking at Bank of America, and Oksana Aronoff of JP Morgan Asset Management, plus a special guest, the former U.S. Vice President, Mike Pence, live from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Let's talk about this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress. I changed during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Up-to-the-minute news whenever and wherever it happens. I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg. All right, we are looking at futures rise. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, no more extensions. President Trump vows there will be no more delays in his tariff agenda come August 1st. And turmoil in metals markets. Copper whipsaws as the president announces a massive levy on imports of the commodity. In the world of tech, Apple's chief operating officer is out, and Meta's AI vision gets sharper as SpaceX's valuation soars. A lot going on in this market today.
Absolutely. From tech to health we go, because we have some M&A. Merck buying UK biotech firm Verona in a $10 billion deal. Merck, as we know, is working to offset losses from that 2028 patent expiration of its blockbuster cancer drug, Keytruda. As you might expect, you have Verona shares absolutely flying pre-market of about 21%, but also Merck shares up slightly as well, to the tune of about 0.8%.
Investors like that deal. Also watching copper-related stocks. Freeport-McMoRan, for example, right now up a little bit more than 1% in the pre-market after President Trump announced a 50% import tariff on that metal. And we'll be watching especially any of the smaller companies that produce right here in America, Katie.
Well, on that note, President Trump now says that he will push forward with his tariff regime with no more extensions, just one day after hinting that his August 1st deadline was not firm. The president then turned his attention to two very specific industries.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that, they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
All right, let's get the state of play from Bloomberg's Washington correspondent, Tyler Kendall. So no more extensions after August 1st, although people, Donald Trump says there on copper, I guess, have a year and a half to come in?
Yeah, hey, Matt, exactly. So we are waiting for potentially these sector-specific tariffs to come down the pipe. We were expecting that they were incoming, considering that this is going to be invoked under Section 232 on the grounds of national security concerns, which meant that the administration had already launched an investigation looking into copper back in February, and then pharmaceuticals, the second sector-specific tariff that President Trump said to expect. That investigation was launched back in April. Now, typically it takes 9 months to get these underway, but it is clear the administration is working on a little bit more of an expedited timeline here, and it's really only going to complicate the negotiations on the so-called reciprocal tariffs going forward, because even though these are tariffs enacted under separate provisions under the law, they are becoming really integral in the conversations, including when it comes to the European Union, for example, which President Trump said could expect a letter in the next 2 days. He said that there will be a wave of tariff letters incoming. We could expect a minimum of 7 countries to receive them this morning. And he said a second batch will be coming later in the afternoon.
All right, Tyler, appreciate the update. That is Bloomberg's Tyler Kendall giving us a lay of the land here. Let's talk specifically about copper, because the president's 50% tariff threat is already impacting the price of copper. You have one Jefferies analyst saying, quote, that the U.S. does not have nearly enough mine, smelter, or refinery capacity to be self-sufficient in copper. Let's discuss now with Joe Doe, who covers the space for us. You had Citigroup also calling this a watershed moment. What do we know so far, and what does the reaction look like?
What we know is the president has said he's going to put a 50% tariff on copper. Don't know what copper, don't know which products, don't know how high or down the supply chain they go, and that the market had a massive reaction when he made the comment. We've seen prices pull back in both the futures traded here in New York and the LME, which is typically the benchmark globally. But we did see prices spike as much as 17% yesterday. I mean, I've covered copper for over a decade. Like, I've never seen that kind of a spike in a price in a one day. So where we sit today is everybody in this market is wondering, what are the details? What are we actually going to get? Howard Lutnick, the Commerce Secretary, said, well, it's done and we're going to get this out, and you'll probably see it in a Truth social post or something like that. We haven't seen anything yet. The market does want detail. There are questions around this like, is it copper cathode, which is like raw copper? Is it copper products like semifab and others? Is it pipes? Is it copper wire? I mean, copper wire is a massive, massive industry in this country because electric grids, everything, right? So everybody's wondering where the price is actually going to be on the tariff.
And when? Also, because we're going to talk to John Wobensmith later, who runs Genco, a shipping company, and I imagine he has clients calling him saying, like, can we send over some copper now, right?
Right, exactly. What we did see a few months ago when we reported that President Trump was speeding up the 232 process on copper, we saw an arb window open up. People were rushing to get copper into the United States, anticipating that the tariff would come on earlier than expected, which meant, hey, let's get this in before we have to pay a higher price. Presumably, you're going to start seeing the same thing now that we're starting to get closer to this actually happening. But I think the question is, like, how much of that, right? Because this had already been happening. The market has been expecting a tariff to come in. I think maybe the big surprise here is that number, 50%. A lot of the market was kind of waffling with maybe it's going to be 25%, maybe it's going to be 10%. They didn't know. But now we have the President of the United States actually giving a number. So we could see that affecting the actual trade flows for the near term.
All right, Joe, look forward to talking more about this with you over the next year and a half. Joe Doe covers metals for us. He's also our economic statecraft czar, so to speak. The president threatening a 200% tariff on pharmaceuticals imported into the U.S. 200%. That threat sending European pharma names into the red. For more, we're joined by Bloomberg's health reporter, Damien Garde. So, Damien, what do we know about the details of this tariff threat?
Well, very little. And in fact, despite the terror, I think, that might be incurred by that 200% number, this disclosure by the president was greeted with some relief by analysts in the pharmaceutical sector because he mentioned that this would be 1.5 years, this kind of vague deadline in the future for which companies would have to bring more manufacturing to the United States. As you might know, many major pharmaceutical companies have been kind of tripping over themselves in 2025 to announce plans to build manufacturing capacity in the U.S. for drugs that they currently import from elsewhere. And so there is, maybe reading between the lines, a notion that Trump's earlier rhetoric about imposing tariffs almost immediately on the pharmaceutical industry, because that has evolved to this kind of like nebulous distant date and this 200% number, that perhaps those companies have succeeded in coming to the White House and saying, look, we can't overnight just start making complicated injectable drugs in North Carolina that we currently make in Switzerland, but here's what we will do. And this is perhaps a sign that that has gotten through to the administration and that they've bought themselves some time, if not kind of escaped some of the crosshairs that had been on them previously.
Yeah, in some ways, there's parallels to the conversation we were just having about copper mining, that there's just not the capacity as it stands right now to have all this production in the U.S. But Damien, I actually want to get your thoughts on another story in the health space, and that is the M&A deal that we saw this morning with Merck agreeing to buy Verona for about $10 billion. We know that Merck has been shopping around, that they have that patent cliff coming up, and it seems like they've found their answer here.
It does. I think what we're seeing, as you mentioned, Merck's patent cliff is that they currently make the best-selling drug in the world in the form of Keytruda, a medicine for many, many types of cancer. It will soon lose its exclusivity, and Merck will have a roughly $30 billion, $40 billion hole to plug in its revenue. They know that there is no one, they're taking kind of a Moneyball approach, I suppose. They know there's no one product that can recreate the effects of Keytruda on their revenue, so they are looking to recreate it in the aggregate, mostly through a series of deals and through their pipeline. So that enter Verona today, which has a recently approved treatment for COPD, emphysema, and other kind of related conditions, that has peak sales estimates in the mid-single-digit billions out into the 2030s, and that is the kind of like single or double that a company like Merck needs in order to prepare itself for the loss of Keytruda's patent life.
Hey, Damien, great to get your take on this. We're going to be digging deeper and deeper, obviously, into this issue over the next few weeks and months as well. Damien Garde there covers healthcare for us here at Bloomberg. Coming up, Sam Altman and Mark Zuckerberg are poised to reunite in Sun Valley, but their fit is going to be much cooler than we're showing you in these pictures. You got to see the glasses Sam Altman is wearing, and I'm looking forward to a pendant over Mark Zuckerberg's turtleneck sweater. Later on, don't miss a conversation with White House Council of Economic Advisors Chairman Stephen Myron. In our next hour, we'll ask him about the effect of tariffs after the big, beautiful bill was signed on the 4th of July. This is Open Interest.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get out of high interest. Look at what's making headlines around the world. A Rivian-backed startup that's developing smaller EVs is getting valued at $1 billion right now in a new investment from Green Oaks Capital. The company, called Also Inc., was spun out of Rivian earlier this year. Also hasn't revealed specifics, but said its tech platform will be applicable to e-bikes and microcars, as well as neighborhood EVs, whatever that is. Mobileye is reporting preliminary second quarter results that beat expectations. It also announced, though, a secondary offering by Intel. Bloomberg Intelligence says the results reflect a stabilization in global auto production, and the offering likely reflects Intel's cash needs. And tech titans are converging in Silicon Valley, Idaho, for the annual Allen and Company conference, an event where billionaires and CEOs rub shoulders and strike deals. Our own Ed Ludlow is there, and he caught up with OpenAI CEO Sam Altman, who said he's looking forward to meeting with Meta CEO Mark Zuckerberg. The pair haven't spoken since Zuckerberg poached some of OpenAI's top engineers. Ed asked Altman his thoughts on AI talent recruitment.
I think we have an incredible, obviously we have an incredibly talented team, and I think they really love what they're doing. Obviously, some people will go to different places. There's a lot of excitement, I guess we could say, in the industry, but no, I think we feel fine.
So that's one feud that's happening right now in the tech industry, which we're going to get to. But let's get to another feud that is underway, and that is Elon Musk responding to longtime Tesla bull Dan Ives. Now, yesterday, the analyst posted recommendations for Tesla's board to consider for Musk when it comes to his divided attention, when it comes to politics and what's actually going on with the business. What did Elon Musk say? He said, "Shut up, Dan." And that, of course, is Tesla's biggest bull on the sell side. Let's discuss with Bloomberg Tech co-host Caroline Hyde. So we're highlighting this because this is having a real impact on Tesla shares, this overarching concern that we have a distracted CEO and he's just getting deeper and deeper into politics and not focusing on some of the fundamental issues that are going on at Tesla.
The issue is Elon Musk has always given very short shrift to analysts, to the shorts out there. He's not afraid to bite the hand that feeds. Dan Ives is the hand that gives it a price target of $500. Biggest bull on the street, actually saying give 25% voting control to Elon Musk. What does Elon say? Shut up. So, I mean, it's an interesting tete-a-tete, but we do see the ongoing concerns that we have a more distracted CEO. Also, a guy who's busy launching an updated Grok later tonight. So he's busy doing that. Grok getting a lot of flack today with some seemingly anti-Semitic commentary happening on the chatbot. You've also got the guy out there raising money for SpaceX. Ed Ludlow breaking the news that it's now going to be worth about $400 billion. That's the most valuable US startup out there, as it raises a little bit more money, but ultimately makes more liquidity for those who've been working there. I think that's a real signal that people are still willing to back Elon Musk and Elon Inc., even though he's busy having a feud with the President of the United States.
It's a good reminder that we've always had these conversations around Elon Musk. He's always been in charge of several different companies at one time, and the SpaceX share sale is a great example.
Yeah, I mean, Kathy Wood was on, I think, Surveillance yesterday saying that she's not worried about Elon Musk being distracted, but he has got a lot to do. I'm waiting to see what Mark Zuckerberg wears to Allen & Co. Like those Varnays that Sam Altman was rocking are truly, I mean, Mike Judge needs to come back and make another Silicon Valley with these characters. They're just amazing.
And where are the cameras and where is the AI infused into your Varney glasses? I thought actually Sam Altman...
the Meta investment, right? Another $3.5 billion into Luxor.
Luxottica? Yeah, they're taking now a 3% stake in the maker of Ray-Bans and Oakleys, who make their smart glasses. They could ultimately take about a 5% stake, according to people familiar. This is them betting big on ultimately the share price improvement in a company that they've anointed to build their technology of the future. Interestingly, I thought Sam Altman was on fighting form today, and well, yesterday when he arrived at Sun Valley, also saying that, look, watch this space for our hardware. That was the last question that was thrown at him. And they were like, what about your hardware with Johnny Ives? And he was like, it's gonna be great. But at the moment he's wearing Varnays. But he's certainly not wearing Meta glasses. I'm pretty sure Zuck will be.
Yeah, and I thought that Meta investment was really interesting because you also saw Warby Parker shares rise yesterday. Warby Parker, of course, wasn't the target of the investment, but maybe some speculation that we're going to see more of these matchups in the future.
And you've already seen it. Alphabet, Google's been getting closer to Caring Group with its glasses. We're likely to start to see more and more companies come out with this new way in which we interact with AI. It's not going to be augmented reality. That's a step too far. The Vision Pro ultimately was too pricey and not the form factor we need. But we do want to have AI in our intermediate lifestyle, and that's going to be with the sunglasses, it feels like.
We should remember, so far, Meta has invested in EssilorLuxottica, and they own both Ray-Ban and Oakleys, and those are the two brands that have been infused with this technology, right? Varney is actually owned by LVMH, so it's a completely different
fashion.
Well, owner, right? So Meta is only making glasses with the brands that are owned by Luxottica.
Yeah.
It's not like they're going to branch out and do something with a different brand that's not owned by Luxottica.
Are we trying to signal as to who OpenAI is getting into bed with? We know that they've got this partnership with Johnny Ive. We know that they've got some legal ramifications with that. And so we'll see who they particularly work with.
I'm so fascinated to see what Johnny Ive and Sam Altman come up with, because the thing about Apple is they really don't need, I know Dan Ives was out with a note today saying they have to make an acquisition, and he's saying perplexity is it. But as long as they own the hardware with which we use AI, it's okay. But if Johnny Ive and Sam Altman come up with something that makes you no longer need an iPhone, then Apple has a real problem.
But then also look at the changes that are currently happening at Apple. We've just had the yet further scoop that the COO, Jeff Williams, who'd been there running the COO role for at least a decade, saying goodbye. At one point we thought he might take over from Tim Cook. They're basically the same age. But the guy who comes in instead, Sawi Khan, he's been there for 30 years. These are people who know the business well. We're likely to see the hardware engineering guy get anointed potentially to take over Tim Cook. That's what people have generally thought. But this is a shuffling of the deck. The people in charge of supply chain here are all being re-galvanized. And look, you have the latest tweet out, well, comment out of Peter Navarro, who's there very much trying to dictate where trade deals go, saying Apple thinks it's too big to tariff. That's the headache for Apple right now. Is that the distraction for that company rather than innovating in AI? You've got Tesla CEO distracted with politics, and you've got Apple distracted being forced to think about politics.
All right, Caroline Hyde co-anchors the Bloomberg Tech Show. You can catch her with Ed Ludlow at 11. He'll be like lurking in the bushes somewhere at Allen & Co. Talking with the billionaire CEO, but I'm sure present on the program. Coming up on this one, we've got a wave of share sale announcements overnight, including, well, this isn't one, but interest in the Chinese business of Starbucks and other potential companies on the block. Details ahead right here on Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back to Open Interest. A check on the setup when it comes to the futures market ahead of the opening bell, just about 7 minutes away. You can see we're up slightly. We had pretty much an unchanged finish for the S&P 500 yesterday with some big intraday volatility. Right now, as it stands, we're about 0.3% higher. Same story if you take a look at the NASDAQ 100. Your big tech names that live there also up slightly. Small guys are winning today. The Russell 2000 up about 0.4%. Probably helps that you have bond markets cooperating a little bit this morning. The 10-year Treasury yield down slightly below 440. Matt Miller.
All right, so overnight we saw a wave of stake sales, share sales, takeover interest from companies like Bank America and Starbucks. Those are the sellers in this. Let's get details from Bloomberg's cross-asset reporter, Isabel Lee. And I should say potential sellers, right? These aren't done deals. There's a lot of speculation here, but I want to start with AES, an energy company with an enterprise value of $40 billion.
It does have that enterprise value, and its market cap is only around $8 billion. So it's a power firm, AES, and it's exploring Options including a potential sale. That's according to people familiar with the matter, and you see shares edging higher by just around 2%. So AES provides power, renewable power, to tech companies like Microsoft, Google, Amazon, and investors including Brookfield and BlackRock have really been studying their shares after they lost half of their value in the past 2 years, of course, due to Trump's anti-renewal policy. So AES, again, to your point, has an enterprise value of $40 billion, which will make it one of the largest leverage buyouts that would rank of all time.
And you can see shares just flying right now, up about 17%. I just want to talk about Starbucks and what's going on with the China unit, reportedly drawing interest for a potential controlling stake here.
Yes, you and I like Starbucks. The shares are also edging higher by nearly 3%. So China is the second biggest market of Starbucks, and Bloomberg reported in May that it is exploring potential review of its company. So now Starbucks is in the process of reviewing those and really shortlisting candidates for a next round of bidding. And this isn't really Starbucks' preferred option. I think that's important to note because they preferred a minority stake that will help them grow their business. But now here we are. And Starbucks really has been struggling in China, and they've tried to cater to local tastes. So they've slashed tea prices. They've made 0 options for coffee. We'll see if it's working, but really they've tried to attract more consumers there.
0 options for coffee?
No, 0 sweeteners for coffee.
Ah, okay.
Maybe I said it wrong. Did I say it wrong or you heard it wrong?
No, 0 sweet. I guess
it was matched
like
back.
no sugar options.
No sugar options.
Bank America, Kuwait.
So Kuwait,
have they lost faith?
Yeah.
No.
That's too strong. Of
In
a
30
statement.
seconds.
Okay, so it's a $1 trillion sovereign wealth fund, and they sold a $3.1 billion stake, according to people familiar with the matter again. So the sale was handled by Goldman Sachs, and they saw it's 1.5% discount to Monday's closing price. I think the most important thing here, it follows Warren Buffett's Berkshire Hathaway's retreat. So Warren Buffett was seen as a white knight, and now they sold out, and we have Kuwait Investment Authority also doing the same, and their backing goes as far as 2008. So that's really
all right. Great roundup, Isabel. That is Bloomberg's Isabel Lee. Stick with us. The opening bell is up next. We'll walk you through the action with Seema Shah. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I never doing that again.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
We are just seconds away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. You're looking at futures that are pointing higher after kind of a flattish close yesterday. 62.94 on the futures. On the cash trade, we're still about 50 points away from the all-time closing high that we hit on last Thursday. NASDAQ futures up a little bit more. Russell, the small caps, up more than 0.5% right now. You hear the opening bells. On the New York Stock Exchange, you've got Arlo ringing the opening bells, and apparently they make security cameras and the like. I should know because the stock is up 542% over the past 5 years. They've been absolutely crushing it, and that's why they deserve to ring the opening bell at the New York Stock Exchange. Meanwhile, down at the NASDAQ, Avidity is a biosciences company, and their stock is up 7% over the past 5 years, so it's better than a loss, but I think they could do better.
Yeah.
I think they could do better.
All right, so if you're listening, Avidity, Matt Miller has some opinions here. Let's stay on health, though, because we have some M&A in the sector. Merck buying UK biotech firm Verona in a $10 billion deal. Merck, as we know, is working to offset losses from that 2028 patent expiration of Keytruda, and that has really been a big overhang for the stock. You can see Merck is actually up a little bit right now, Matt Miller, about 1.6%. Verona obviously is flying, but Merck down about 33% over the past year, which is a big loss.
It is a big loss, but it looks like investors are behind this acquisition. Today, we're also watching copper-related stocks. Obviously, after President Trump says the tariff could go up 50%, customers are going to rush to bring in copper now. You can see Freeport-McMoRan, the first name that comes to mind, up about 0.8%, so a gainer there. The smaller, I'm looking at Ivanhoe Electric, for example, which makes copper right here in the United States. It's a small company, just about $1 billion, but it was up 5% yesterday, another 3% today. Equity volatility in general is poised to pick up in coming months. Goldman Sachs strategist led by Christian Müller-Glissman right, that, quote, a deterioration in tariff discussions remains a key risk, but fiscal concerns in the U.S. or U.K., potential French elections, and geopolitical tensions could also drive more volatility. Let's bring in Principal Asset Management Chief Global Strategist Seema Shah. And obviously, I don't care about the UK or France, Seema. Don't even know where they are. But the U.S. markets could see more volatility as these tariffs continue to be dragged out, right? August 1st is now the deadline, no longer July 9th. And the president says copper tariffs could come in a year and a half.
Yeah, and I honestly don't think that even the 1st of August is going to be the end of the story. I mean, ultimately, you know, if you look back through history, trade deals take a long time to take place. Even whatever is announced on August the 1st, there's still going to be a long way after that. So in that period, there's always going to be the potential for resumption of hostilities, and it's going to continue to be a negotiating tool. So from our perspective, tariff noise, that's something which becomes a permanent feature of the economic backdrop. It's really whether or not the market's going to continue to take notice of it. But certainly in the next month or so, given where equities are sitting today, there is some vulnerability in that near term.
Is there, though? Let's talk about that a little bit more, because you get these headlines out from, of course, President Trump, especially in yesterday's cabinet meeting. It just felt like a grab bag of different industries that were being targeted, from pharma to copper, et cetera. And it just feels like there's not too much reaction, at least in the overall benchmarks anymore, like there might have been a couple of months ago even.
Yeah, that's absolutely right. And I think one of the things is, to your point, is the way that it was always almost announced was a bit off the cuff. There's absolutely no details either. So I think the market is also looking at that. But at the same time, I think one of the factors that I think markets are considering is that when you're thinking about copper, 50% tariff could be fairly negative for the US economy. So is President Trump genuinely going to go ahead with that kind of number? I think it's fair that the market is questioning it and saying, well, look, in the past, every time that there's been a really meaningful threat to the economy, he has taken a step back. So potentially this is a negotiating tool.
I kid, Seema, about not knowing where France is. Obviously, I've lived in Europe for many years. And those benchmark indexes have really crushed it compared to the S&P, right, which is up, what, 6% year to date. We're looking at, on the CAC 40, a 20% gain. On the DAX in Frankfurt, a 40% gain in, if you're a dollar investor. How much legs do you think those European index rallies have? Or do you see a reversal here? Is the U.S. now going to play catch up and you can sell some European stocks and put those profits into America?
Well, look, I think in the near term, as I said, I think there is some vulnerability for the US, given that there's so much headline risk in the next month or two. But if you're looking beyond that, I think Europe is maybe getting to the end of this current rally, starts to lose some steam. That doesn't mean it's going to be reversed. But I think you're getting to the point where investors are looking at the fundamentals, they're looking at the earnings expectations, and they're saying there's a bit of a mismatch. And we know, of course, a lot of it is driven by these hopes around what fiscal stimulus can do for the European economy. But we do know also that typically and historically, Europe has been a bit of a disappointment when it actually comes to implementation. So we're getting to that point where European investors are saying, look, show us the money, show us actually what is going to come through, when is it going to come through, and how is it going to be spent? And then, of course, there's a potential for a further run-up. But I do think at this point in time, you're going to see a loss in steam.
Well, we should probably get some more clarity when it comes to at least the corporate picture in the next couple of weeks. Earnings season is fast approaching. The big banks kicking us off next week. And bringing back the conversation on tariffs, there was a really interesting note from Deutsche Bank yesterday, basically estimating that there could be a 2 percentage point hit to S&P 500 earnings amid all of this tariff noise that we were just speaking about. When you run your own models over there at Principal Asset Management, do you end up with something similar?
So look, we do think the S&P 500, a lot of companies are definitely exposed. I think the key question for us at the moment, though, is when does that hit come? It's not entirely clear that it is even on the doorstep, given that there's been so much front loading of imports in the last couple of months. And even from the Fed's perspective, this is really going to be key, is when do we actually see that data materializing? When do you see an increase in prices? And at the same time, we also don't know exactly how much companies are going to be able to pass on the price increases. So I do think that as the earnings season gets started next week, it's going to be really interesting to read through that forward guidance and hear some of the narrative that these CEOs are talking about and how they're seeing any implication from adjusting supply chains.
We're looking at NVIDIA. I just want to point out to viewers here, Seema, NVIDIA shares continue to march higher. It is the biggest point gainer on the S&P 500, and it's about to hit $4 trillion in market cap. Is this, continued march higher just inevitable, Seema? It doesn't seem like there have been really any big competitors able to unseat NVIDIA, even as, the Chinese continue to try and have to eventually come close, right?
Yeah, I don't talk about single stocks, but I can talk about just generally the technology sector, obviously driven by NVIDIA here, is that has been a discussion point which continues to drive markets. It lost a bit of pace earlier in the year because of the emergence of DeepSeek, but people are really continuing to buy into that general thesis, that kind of long-term narrative that AI is going to be the key driver of all productivity growth. We haven't seen that disappear. And interestingly, technology is actually the sector which is most exposed to tariffs because it has majority of its revenue outside of the US, and yet it's continued to outperform. So I think this gives us an idea that investors are looking through a lot of the tariff noise, and they want to see that narrative continue. So tech earnings next week, as the coming weeks go, is going to be absolutely imperative in order to make sure that beyond the next month or so, you do see these continued gains in US equities.
Absolutely. It feels like the stakes just get higher when it comes to tech earnings. Seema, great to have some time with you. That is Principal Asset Management Chief Global Strategist, Seema Shah. Let's get a check on some of these movers and the makeup of this market right now. You can see the S&P 500, it's in the green, and a lot of that comes back into NVIDIA. As Matt was just mentioning, we are closing in on $4 trillion for market cap. NVIDIA is your biggest points contributor to the S&P 500 right now, up about 2.2%. And that, of course, is fueling this entire market, though you do have the likes of Microsoft, Amazon, some of these other tech names certainly helping as well. You can see the S&P 500 up by about 0.6%. Let's take a look at the downside. There are more winners versus losers right now, but to the downside, you do have United Health Group down about 1.6%, Palantir, Apple, as we've been discussing, those woes continuing, and you can see that reflected in the single stock stories. But let's take a look at the sectors as well and see the makeup there. More green than red. Up at the top, you do have tech. Thank you, NVIDIA. Consumer discretionary as well. At the bottom, what's not doing too hot today, utilities, consumer staples, and energy, but small moves overall, Matt Miller.
Yeah, still so much news in this market that you can't take your eyes off it. Coming up, SpaceX is raising money and selling shares at a nearly $500 billion valuation, according to sources that have talked to us here at Bloomberg. We'll discuss that with the reporter who broke the story next. And in the next hour, we speak with Goldman Sachs Chief U.S. Equity Strategist David Kostin. He'll join us right before we get a chance to speak with the White House Council of Economic Advisors Chairman Stephen Myron. So a ton of news today and a ton of amazing guests that you don't want to miss. Keep it dialed in right here on Bloomberg Television.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure bill in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wynn Resorts getting a downgrade over at Citi. The analyst says that he sees Wynn giving up gaming market share in Macau in the near term. Shares down slightly. Next up, we have T-Mobile getting a cut to a sell over at KeyBank. The analyst over there saying that the stock's underperformance will continue and that its premium valuation is still too high. And finally, we have Microsoft getting upgraded to a buy over at Oppenheimer thanks to AI upside. The analyst says that investors should embrace Microsoft as one of the long-term AI winners in software, Matt, and shares are up about 1.4%.
All right, let's talk about those people who are investing in this technology. Executives have descended on the Allen and Company conference in Sun Valley, Idaho. They include OpenAI CEO Sam Altman. He spoke with a gaggle of reporters about explosive growth in AI and tech.
I am a believer in technology and science and economic growth, and sort of, I think that I'm all for offering great services, and I'm all for figuring out ways to make capitalism super inclusive. But I think part of the thing has got to be we drive the country towards very significant economic growth.
The more I see those glasses, the more I want my own pair. Altman spoke after a Bloomberg scoop that SpaceX is discussing plans to raise money and sell insider shares in a deal that would value the company at $400 billion. That would make it the most valuable startup in the world. Bloomberg Tech co-host Ed Ludlow broke that story. He joins us now from Sun Valley. So first, on the SpaceX sale, give us the details, Ed.
Sure. Yeah, it's a mechanism that they've used historically, which is concurrently a very small primary, selling a small amount of fresh equity to set price and therefore valuation. But the main thing is the tender, secondary, right? Give employees liquidity, allow early investors to have some liquidity as well. And it's a big moment. There's been a lot of tension between Elon Musk and the president. SpaceX has great regulatory exposure as well as a lot of business exposure to United States government and various defense apparatus, but it shows continued growth both on the launch business and on Starlink as well.
I do just want to quickly mention NVIDIA. We were talking about it last block. Its rise continues, and it actually now becomes the first company to reach $4 trillion in market cap. So NVIDIA ascendant this morning, and really for the past couple of years, we'll continue to keep an eye on that. But when it comes to SpaceX, part of this rise in valuation, Ed, comes back to Starlink. So talk to us a little bit about what the state of play is there, because that has also come under scrutiny.
Yeah, I mean, over time, the proportion has shifted, right? Starlink becomes more than 50% of revenue. It's higher margin business. You know, the business of sending rockets into orbit, regardless of the payload, is never going to be a big cash cow. And SpaceX increasingly facing competition, Project Kuiper from Amazon, but that's where there's a lot of hope. You know, SpaceX, like many of Elon Musk's companies, it's so hard to get into. You have the biggest private growth equity names, largest venture capital firms, other technology companies, Elon Musk's close confidants and friends, other sovereigns. But the hope is that in the longer term, the Starlink bit will be spun off. There'll be either some kind of listing or opportunity for a broader investor base to participate. And that's part of the story here around the valuation too.
Ed, I can't look away from NVIDIA here. I mean, more than $4 trillion in market cap. I will never forget when you were on air and Apple crossed the $3 trillion mark. I have that phrase ringing in my ears all the time when I think about this climb in the value of artificial intelligence companies. And in a sense, they've left Apple in the dust, right? I know we use Apple devices for the OpenAI app, but Apple hasn't made any moves, really any big moves here. Dan Ives was out with a note this morning saying they should buy Perplexity. What's your thought?
I saw that. Yeah, I mean, what's so astonishing is that Jensen Huang's not here, right, in Sun Valley, but all of his biggest customers are. Andy Jassy of AWS, Sam Altman, Satya Nadella, not just a customer, but obviously an investor and partner. And what they all have in common is that they've made continued commitments to not just big picture expand data center capacity, but NVIDIA has this commitment to bring out a new generation of GPU annually. And so you have two things happening: a broader expansion of capacity, where NVIDIA holds a monopoly more than 70% of the market, but also a refresh, a technology cycle that's gone from being multi-year to annual, which is astonishing. And people rely on that technology as a bedrock of what's happening. On the Perplexity thing, it's not a deal that I've been hearing about here at Sun Valley, but it's been talked about for a little while. We had Perplexity's chief business officer on the show last week, I believe, and we asked him point blank, and he wouldn't comment, but said, you know, he wouldn't be doing his job if he wasn't talking to everyone. The ecosystem on the operating system side is really changing, but NVIDIA 4 trillion, yeah, cool moment. It's weird not to be in the studio for it. But you guys did it. Congrats.
You're in front of a mountain, which is also pretty good. NVIDIA shares up about 2.5% right now, eclipsing $4 trillion. And we had Ed Ludlow right here with us. You can catch more of Bloomberg Tech co-host Ed Ludlow at 11 a.m. Wall Street time right here on Bloomberg TV. And we didn't even get to this meeting that could be happening between Sam Altman and Mark Zuckerberg. I know we talked a little bit about it, but not enough. We've been having so much fun with this story.
Yeah, I mean, it will be interesting, unlikely in front of cameras, right? So we're not going to see that meeting. And also, who knows if they're going to talk to each other in an amicable way? Are they going to be angry with each other?
Fisticuffs, perhaps?
I doubt that is going to happen.
I don't think so either. It would be nice if we could get an official readout, like they were presidents of a country, but we'll continue to follow that story. And up next, we're going to talk about airplanes, because Boeing hits an 18-month high for jet deliveries. More on Boeing shares and the other airlines, or rather the airlines in general, next. This is Open Interest.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, U.S. plane maker Boeing delivered 70 aircrafts in June, and that is the most in 18 months, thanks to renewed U.S. jet exports to China. For more analysis on Boeing and the overall airline sector ahead of earnings, we're joined by Savvy Sith. She is Managing Director for Airlines over at Raymond James. It's great to have you with us. Let's start with Boeing, because there's obviously a lot underway when it comes to Boeing and their turnaround efforts, but there's also an element of trade policy here, and it seems like for now, those winds are blowing in Boeing's favor.
Thanks for having me, Katie. You're exactly right. It's it's great to see Boeing kind of turning around things and really showing improvement here in 2025. There is a lot of kind of uncertainty around the tariffs, and where components are made, and hopefully we'll kind of stick to the policy that was there before, which is that kind of global aviation supply is kind of tariff-free. But from an airline perspective, what we've been hearing is kind of Boeing has been delivering on time relative to new schedules and sometimes even faster, which is encouraging after several years of delays and mishaps. So, overall, a good setup here.
If, the airlines that you cover, Savi, for example, Delta, which announces earnings tomorrow, they use Boeing. They're never going to switch over to Airbus, or have they been doing that?
Thanks, Matt. Yeah, if you look at Delta, they fly both, operate both Boeing and Airbus aircraft. So the largest carriers, American, Delta, and United, they fly both types. Southwest is another big carrier in the U.S. They're solely Boeing. So it's in their interest to kind of see a successful Boeing, but also have a kind of a tariff-free environment overall.
And focusing more specifically, of course, on the airlines, we got Delta kicking us off tomorrow. It just feels like demand hasn't been there. It hasn't returned to really robust levels. Occasionally, we get these bursts of optimism and you see shares pop, and then we go right back to this sort of sideways chop that we've had for the past couple of years. Are you expecting something different here, or maybe more of the same?
Right now, we're seeing just more of the same, unfortunately, Katie, because, if you look at, you're quite right. You're seeing some, green shoots that maybe we'll see demand at least progressing closer to where it was at the end of last year, early this year. But then some headlines will hit and you'll see a reversal again. What we'd be looking for, at least post-summer is there a change in corporate travel behavior? If we have more clarity around government spending, how stimulus is working, how tariffs end up, is there more comfort or certainty in for some of that corporate travel to come back? So that's what we'll be looking for. But right now, there's no change that we can discern.
All right, Savi, great having you on the program. Thanks for joining us. Savi Sit there of Raymond James talking to us about airlines after Boeing deliveries came out, and tomorrow we get earnings from Delta. Now, NVIDIA is really in our focus. It is the first ever $4 trillion company. You're here for an historic moment as the company crosses over that $4 trillion mark. It is, of course, the most valuable company in the entire world, and we're going to continue to focus on it. Coming up in the next hour, Goldman Sachs Chief U.S. Equity Strategist joins us, David Costin, as well as White House Council of Economic Advisors Chair Stephen Myron.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and We have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well. Norma Linda, Paul Sweeney with you here. A lot coming up today. We're going just a few moments. We're going to be joining a conversation on Bloomberg Television with U.S. Council of Economic Advisors Chairman Stephen Myron. He's speaking with Bloomberg Television anchors Sonali Basak and Matt Miller. We will take that in just a couple of minutes. After that, Mark Niket, Bloomberg Realist Economy Reporter, talks to us about the tariff situation. Where are we? Who's getting tariffed? Who's not getting tariffed? And what are the delays? And what's the time frame there? So we're going to get the full tariff overview. Peter Cheer, head of macro strategy at Academy Securities, will join us and give us his thoughts on these markets. Damian Gard, Bloomberg News health reporter on Merck, is going to buy another deal, Verona, $10 billion as patent cliffs loom. So another big deal in the healthcare space. Tim Craighead, Bloomberg Intelligence. He runs the research stuff over there in Europe for Bloomberg Intelligence. They've got their mid-year 10 best ideas for the second half of the year. So we'll see what they're saying over there in London for Bloomberg Intelligence. So a lot going on there. Let's kick it off. John Tucker with a Bloomberg Business Flash.
All right, guys, and this Bloomberg Business Flash being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ipakr.com/round-the-clock. Well, this morning, NVIDIA has become the first company to be valued at $4 trillion. And this has given a lift to all of the boats in the bay. Microsoft, that's climbing on an analyst upgrade this morning. You have the S&P 500, 40 points higher, 62.65 at the index. The Dow up 207 points. NASDAQ 100 right now at a record up 210 points. That is up about 0.9%. Shares of Apple, right now, little change. The White House trade counselor, Peter Navarro, told Fox Business the iPhone maker thinks it's, quote, too big to tariff. AES, the best performing stock in the S&P 500 right now. This is the company that provides renewable power sources to some of the tech giants. AES.
you. I appreciate that. Norma, Linda, Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube. Nora, market's grinding higher again.
It's so interesting. I mean, what, the NASDAQ 100 at a record high. We're really just seeing these stocks pushing forward despite all of the uncertainty that's still out there.
Yeah, Tom Keane, I think, said it correctly. The market just kind of grinding higher here. Here we are, again, new highs on the intraday basis. The S&P up 0.6%, the NASDAQ up 1%. So there you have it. All right, coming up in just a couple of secs here, U.S. Council of Economic Advisors Chairman Stephen Myron. He's going to be speaking to Bloomberg television anchors Sonali Basak and Matt Miller. A lot to talk about from an economic front, from a tariff front. What does it mean for the economic outlook for this country in terms of GDP growth, inflation? A lot of uncertainty in the marketplace out there. Perhaps this conversation will help clear up some of investors' questions. Right now, let's go to Stephen Myron. I want to now bring in our Bloomberg TV and radio audiences worldwide. We're going to simulcast this. Joining us now is White House Council of Economic Advisors Chairman Stephen Myron. Stephen, thanks very much for joining us. We were just listening to David Kostin of Goldman Sachs giving an optimistic view of the stock market and the way companies are dealing with tariffs. And I wonder how you think about the uncertainty that this creates. You definitely must have calculated that in coming up with this strategy. And if we're going to see an end to that uncertainty come August 1st.
Good morning. Thanks for having me. Look, I do see the uncertainty starting to reduce in the near term. Part of the benefit of uncertainty is it gives us leverage in negotiations, right? Like the president knows how to extract concessions from our trading partners, and he has been very successfully doing so. Now, as what you've seen with a number of these letters is there's some countries that haven't made the concessions that the United States requires, and as a result of the decades of accumulated trade deficits, the president has decided that tariff rates should ratchet back up for those countries on effective August 1st, and I expect that to happen.
I want to talk more about the sectoral tariffs, the Section 232. You look at copper just over the last 24 hours and the price increase you've seen in copper alone. This is a critical input for data centers, for power grids, for industrial machinery. And as the administration looks to bring more manufacturing onshore, how isn't it the case that a 50% tariff would impact some of those other efforts to otherwise power the economy?
So you have to differentiate between changes in relative prices and changes in the general price level. And when you target a specific good with a tariff like copper or some other specific good, you're going to get relative price changes, and that's totally expected. But that doesn't mean that there's an increase in the general price level, by which we mean inflation, because there are lots of thousands of products and services that go into the general price level, and it's an average, a weighted average across all of those. And we just published research yesterday showing that there has been no tariff-induced inflation in a general price level since the tariffs began being implemented in January. Quite to the contrary of all of the Cassandras that were shouting that it was going to be extremely inflationary. There's just no evidence of that thus far. Just
Stephen,
like in 2018, 2019. Yeah.
Listen, I read the research, and we'll get back to it, but on copper, I want to read this note from Jefferies. They say that the U.S. does not have nearly enough mine smelter refinery capacity to be self-sufficient in copper. So then why target it?
Well, we need more of it. We need more of it produced domestically. There are certain critical minerals, of which copper is one, that you just absolutely need if you're going to have a manufacturing sector. And having a manufacturing sector is important, not just economically, because it tends to be a high capital, high productivity field with good paying jobs, but also for national security. You cannot defend yourselves if you do not have a robust manufacturing sector, and critical minerals like copper are essential to that. So will we be able to corner a market in copper? Absolutely not. But can we make more than we currently do? Yes.
So how long will that take? I mean, for example, when will these copper tariffs go into effect? Or is this just a stick rather than a carrot that you use to try and motivate the industry?
No, well, the president said we're going to do copper tariffs, and I think the president, and I think the president follows through on his promises. So I would expect them to happen. I don't have a date for that happening. Yeah. Well, I don't have a date for that happening. That process is underway.
All right. I want to ask also about the first point that you made, using tariffs not necessarily as a revenue raiser, but as leverage in discussions. I've watched Japan tariff U.S. automakers for decades now, and they refuse to back down. Are you going to be able to extract that kind of concession from such a stubborn economy?
Look, I think that the president is one of the best negotiators in history. I mean, he's spent decades negotiating deals across every field, from commercial real estate to international trade, and I have no doubt that he can negotiate successfully now too. But in order to negotiate successfully, other countries have to know that you're serious and that you're willing to do what it takes to get there, and that's what these letters show, that we are absolutely serious. So I hope that a country like Japan comes to its senses and does make the concessions they need, because it'll be better for them if they do.
Stephen, I do want to go back to your report, and I do appreciate the reports that have been coming out of the Council of Economic Advisors. I have been reading all of it. On the most recent report on the imported goods inflation, what do you say to the people that are looking at the impact of energy prices? Because if you subtract petroleum, you're not getting the same impact. In fact, you're seeing the price of goods rising in many categories that matter to American households, like electrical equipment and appliances.
Yeah, so you're right to flag that energy prices have come down and that we got to the lowest price at the pump since 2021, I think. And that's been a huge advantage to American consumers and a huge advantage to the American economy. It does drive the overall, some of the overall indices in the inflation data. But even if you take energy out and you look at core goods, as we do in our paper, or durables, you still see the same wedge. No matter how you slice the different goods data in the inflation data, there's a consistent roughly 50 to 60 basis point wedge between the price increases in domestically produced, in overall goods versus the price increases in imported goods alone. And when you annualize that 50 basis point wedge, obviously it comes to a bit more than a percentage point at an annualized rate. And so when you slice things like taking out energy or just looking at durables or whatever, you end up with different levels, but the wedge between overall goods and imported goods remains. So the conclusion continues to hold.
So I also want to ask about the central bank here. The president himself has been very, very vocal for the desire for lower rates. He has said just recently on Truth Social that 3 points is too high, and he's talking about the interest costs that are embedded with higher interest rates, which of course is a good point when you do have interest costs about to reach $1 trillion or more pretty soon. But at the same time, he has been very critical of the Fed. I want to read you this note from Neil Dutta over at Renaissance Macro. He's basically saying here that the pressure that the president is putting on the Fed is making it so that any future nominee has to be beholden to what the president is saying. What Neil Dutta said is Trump has created a litmus test for his Fed nominee. They have to agree to cut rates. If Trump picks someone close to his orbit, that person will look like a complete toady, and I'm quoting the research, and have a limited ability to persuade colleagues to a dovish position. At some point here, is the president's weighing in on central bank policy counterproductive for what should otherwise have been an independent central bank?
Thanks. So, look, I'm a huge fan of Neil, and I get along great, but I don't agree on this point. I don't think that at the end of the day anything matters but what the policy rate is. I think, sort of sitting around talking about, about optics and committee, sort of internal committee discussions doesn't really matter. What matters is what the policy rate is and what markets expect the policy rate to be. And if they expect the policy rate to be better for the economy, then we'll have better economic outcomes, and markets will welcome that. If the policy rate is set in a way that's not better for the economy, then we'll have worse economic outcomes, and markets will reflect that. I think the rest of it is just chatter. What matters is policy being set well, or is it being set poorly?
Stephen, can I ask about just the basics of raising revenue? What do you expect from tariff revenue, say, over the next 3 or 4 years, since that's what's left in this term? And what about golden visa revenue? I heard Howard Lutnick saying that you've got 75,000 applicants or queries, and at $5 million apiece, that would be like $375 billion, massive amounts of revenue. If you could, can you repeat that every year and bring in like at least $250 billion in revenue every year from selling visas?
Thanks. So I expect the tariff revenue to be substantial. And in the research we put out about the deficit implications of the One Big Beautiful Bill and the rest of the administration's policies, tariff revenue played a substantial role in thinking about where the deficit would go in future years. We had about $3 trillion over a decade from it, which works out to obviously about $300 billion a year. And that's pretty close to where CBO ended up to when CBO got around to scoring it. So that's a number that I think is a reasonable baseline expectation. Given tariff rates are going a little bit higher now, the number might actually be a bit higher than that. So, I think it's such a fantastic thing to raise money from tariffs that are ultimately, the incidence of which is ultimately borne by the tariffed country, and use that money to finance lower marginal rates in American families and American firms to encourage more investment and more work here and encourage reshoring. I think that's just a fantastic common sense policy combination. With respect to the golden visas, I mean, look, I think that Howard has enormous demand for these things. He's created an amazing product. Howard and the president have created an amazing product that has attracted enormous amounts of interest from foreigners abroad, and I think we're going to see that huge demand materialize. However, I think you're right to point out, I don't expect that demand to reproduce every single year. It's not going to replicate every single year. I think you'll see a big demand up front.
All right, really interesting stuff, Stephen. Appreciate your time. White House Council of Economic Advisors Chairman Stephen Miron. All right, that was U.S. Council of Economic Advisors Chairman Stephen Miron speaking with Bloomberg's Sonali Basak and Matthew Miller, giving us the latest thoughts from the administration on tariffs and their implementation. So we'll stay on top of that story because it is a leading story here. I'm going to continue with that. Bloomberg News has been obviously all over this story on a global scale. Mark Niket joins us, Bloomberg Real Economy reporter. Mark, based upon what you heard from Mr. Miron and what we're hearing from President Trump and seeing on his social media, what's the latest understanding of where tariffs are going, in fact, in the next several days and weeks?
Well, the indications are that the August 1st deadline is serious, that the president is committed to imposing these tariffs. Today, of course, was the deadline for the expiration of the pause of the Liberation Day tariffs from April 2nd. And there were questions about whether this continuation, sending out these letters and setting the August 1st deadline was sort of a real extension just to give more time to finalize some of these deals they have in the works with India and some other countries, or if this was a sign that the president was not serious about imposing these tariffs at the levels that he has been talking about. And I think the conclusion is the latter, that he is serious, and that come August 1st, if we don't see trade deals or at least frameworks established with these countries, that these tariff rates at the high levels are going to go into effect.
Well, Mark, of course we know yesterday President Donald Trump announced a 50% tariff on copper imports. And we, of course, are seeing copper rise to levels we haven't seen in quite a while. How important is copper to the overall economy?
It's critical. I mean, copper is used in all kinds of industrial production, data centers, and as you pointed out in your interview with Stephen Miron, like 36% of the demand is imported. There just is not domestic capacity for mining and smelting and producing of copper. So we're reliant on copper imports for our industrial uses, in particular in the U.S.
What's the latest, Mark, with two of our leading trade partners, Canada and Mexico? Where are those negotiations? Where are those tariff levels? Because, I mean, you got to really focus on who are our top 2, 3, 4, 5 kind of trading partners here.
Yeah, I think those are still in flux. I mean, we obviously had the USMCA that should be in effect and is in effect, and is staying some of the tariffs that the president had announced early on. But I think those discussions are still ongoing, and there's still uncertainty about exactly where they're going to land when it comes to the tariffs on Canada and Mexico in particular, because obviously important to the auto industry and other industries, and they're watching very closely to see where those land.
Mark, you talked about just how important copper really is to a lot of industries in the United States. Can you speak about the effect of these tariffs on derivative copper versus maybe raw copper?
Yeah, I'm not that familiar with that element, and I know there's some questions about scrap use of copper, and some suggestions that the industry would be better served by having tariffs on scrap. But as far as the impact on the derivatives, I'm just not sure.
Pharmaceuticals, that seems to be an area that is also on the radar screen for President Trump. What do we know about the administration's view of the pharmaceutical imports?
Well, at the cabinet meeting yesterday, President Trump threw out a number of 200% tariffs on pharmaceuticals. we've been expecting these sectorial tariffs to land, including on pharmaceuticals. But I don't think the expectation was that the number would be that high. So again, I think we're waiting to see exactly where the administration is going to land on these sectorial tariffs. But the pharmaceutical companies aren't waiting. We saw a huge increase in imports of pharmaceuticals in March and April. Ahead of these tariffs that the pharmaceutical companies are expecting, particularly from Ireland, where a lot of the drugs that are imported come from.
Mark, what's the biggest threat to GDP growth right now and the overall state of the economy?
I think it's the uncertainty that the tariffs are having and the chilling effect it's having on investments. Companies just aren't able to make business decisions, including CapEx decisions, not knowing what the tariff rates will be and whether the tariffs will change. There's some questions about whether the uncertainty about tariffs might actually impede the boost that we might see, particularly in CapEx, from the big beautiful bill. There were 3 business tax provisions included in that bill that were made permanent that manufacturers in particular were looking for. That the expectation is it's going to increase CapEx and give companies more confidence to make purchases of equipment in factories. But with the uncertainty of tariffs hanging out there, I think the thought is it's going to have a dampening effect on whatever boost we might see from the big beautiful bill.
All right, Mark, thanks so much for your reporting. Appreciate that. Mark Niket, he's a real economy reporter, Bloomberg News, joining us there, getting the latest on the tariff discussion, which is a fluid situation, and we are following it closely as a team globally. Let's get a reset here of what's happening in the markets. We'll go to Mr. John Tucker on Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash is being brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Let's start with the most active stock. That's NVIDIA. They have become the first company in history to achieve a $4 trillion market valuation. Shares of NVIDIA right now up 2%, and the stock has risen more than 20% year to date. Best performing stock in the S&P 500, that belongs to AES. This is the company that provides renewable power sources to some of the tech giants like Microsoft. This company is exploring options, including a potential sale. They have definitely gotten takeover interest. Shares of AES right now up close to 17%. And Samsung Electronics introducing 3 new foldable smartphones. The $2,000 Galaxy Z Fold 7 and the $1,100 Galaxy Z Flip 7 are thinner and lighter. They're also trying to get ahead of Apple. Apple's going to come up with its version sometime next year. S&P 500 right now 37 points higher. That's up 0.6%. 62 on the index. The Dow up 200 points. NASDAQ 100, that's a record, up 179 points. That is up 0.8%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Nora and Paul.
Thank you, John.
You're so welcome.
We're looking at markets that are in the green right now. Of course, we know we sold off a bit yesterday, especially as we were getting a lot of those headlines on tariffs. But today we're pointing a bit higher. And we have Peter Cheer. He's head of macro strategy at Academy Securities. He's here to discuss the latest on tariffs, how that's really affecting markets, and where investors are looking right now. Of course, we did have a bit of a pullback yesterday, but as I mentioned, Peter, we are pushing higher this morning. We have earnings season that's also starting off on Tuesday, kicking off with JP Morgan. What impact do you really expect tariffs and this whole broader conversation to have on earnings season?
It'll be interesting to see 2 things. One, if there's any slowdown in foreign sales. I think, globally, the economy is probably slowing a little bit, but also I had some concern that foreigners would not want to buy U.S. brands at the same pace maybe they have in the past. So we might get a little inkling of that. That to me would be very important. And then separately, do we still have tariff uncertainty? And I think the market's pricing in that we don't, but it feels to me that it is there. And I think corporations are actually going to support that view, that they are still hesitant to do a lot of spending away from AI because that's just developing efficiencies until they get more clarity.
Peter, this is a market that I think Tom Keene earlier this morning aptly described as grinding higher here. How do you feel about this? This market's moving higher with a lot of uncertainty out there, a lot of crosswinds at the very least. What do you make of this just broader market move higher?
I'm probably a little bit confused since tariffs have come back on the table. I was liking a lot of things. I think when we struck in Iran, that really helped reestablish, peace through strength. I think it was very positive. It's developed some momentum for the country. It helped lead to 5% commitments from NATO. So that was, I think, good. Getting the big, beautiful bill passed, I think, was, good. Not so much in the details, but just getting something passed. That something actually making it through into law versus executive order. So we had that positive momentum, and I was really hoping we would switch much more to, national production for national security, a real focus on making sure that we can develop, process, refine rare earths and critical minerals here. And instead, we kind of flip back towards tariffs, and that makes me nervous.
Peter, this market, equity markets, are looking a lot different than they did on April 2nd when we had that Trump Liberation Day. Do you think that investors are maybe just not taking this as seriously, especially with the pushback in the deadline for tariffs here?
Yeah, and unfortunately, I think we almost have to not take it seriously, because not only do we kind of forget that we pulled back, but we actually did implement those tariffs, right? I believe they were actually in place for 24 hours or something like that before we, did the pause, reset. So I think everyone's looking at this and just, it's difficult to get too concerned. Having said that, I think the president does like the tariff revenue. And my view of the president has always been, when things look really, really bad, he's not going to let it get too bad because that's not his style. But when things get really, really good, that's when he might try something new. So I'm leaning towards, I want to buy some puts here. I want to buy some hedges, because I think he's probably more serious about tariffs than the rest of the market's pricing in right now.
All right. I'm an old school equity research analyst. I think earnings matter. What do you expect to hear from corporate America starting next week with JP Morgan?
I think we're going to hear a little bit of conservative estimates going forward. When I talk to a lot of corporations, the message that I kind of deliver, and I'm not getting much pushback on, is that wherever you think the economy is for your industry, you almost have to behave as though it's one or two notches worse than that, right? There's so much uncertainty out there. And I think if you go ahead and spend a lot of money, aggressively develop, plant, property, and equipment, and it doesn't go well, your shareholders will be mad, your board will be mad. If you don't invest and have to play catch up, I don't think the shareholders are going to be quite as mad. So I think everyone's behaving a little bit conservatively, and I thought we might break through that until we started this tariff uncertainty again.
What's the latest with the U.S. dollar? Are tariffs still the driver here in terms of where the U.S. dollar goes?
Yeah, and I think this comes down to there's less overall interest in investing in the U.S. And listen, I look at treasuries as kind of very generic. So I think it's an easier one. If you want to avoid treasuries, you can. You can buy, German bonds. Even in Japan, you can actually get some yield. I think corporate credit does okay because people still need to have broad, diversified portfolios in corporate credit, and you have to come to America for that. And our equities will do okay, because the reality is we talk about them as American equities, but most of the S&P 500, you just mentioned NVIDIA, they have huge global sales, right? These are massive global companies, so they're not exactly US only. And if you're in the rest of the world and you want exposure to tech, AI, the things that matter, you're going to go there. But I think, are you going to build equipment here? Are you going to do a lot of investment here? I think that's slowing down, and that's why we're seeing some dollar weakness, even when you see other assets rally.
Stocks, bonds, commodities, I don't know. Where do you see the best value out there, Peter? What are the conversations you're having with your clients these days?
And it hasn't played out as well as I would like, but I really do think you're supposed to invest in what we've been calling national production for national security. So what are the things that are going to be kind of critical or, almost no fail that we have to have some amount of this produced domestically? So I think you want some commodity exposure. I think you want exposure to those people who are good at refining and processing commodities. That is going to be key, right? Again, I get laughed at, and I'm probably deserve to be laughed at, but I point out that oil is kind of useless. And I don't really mean that, but what I do mean is that gasoline and diesel are incredibly useful. We don't refine enough of that domestically, right? So I think all these things have to pull together. Companies that can be, a big part of the rebuilding of the infrastructure to support that should do well. So I'm kind of into that. I like biotech. And again, I think our own chip manufacturers should do well. I've been a little bit frustrated with how we've held back on some of the CHIP Act money and that there hasn't been enough, progress for myself in terms of government support for the chip companies. I think that starts coming in the second half of the year. Bessent wants this. So I really like domestic chips. I like biotech and ultimately, hard commodities and those refiners and processors.
Peter, excellent as always. Peter Cheer, head of macro strategy at Academy Securities, joining us via Zoom here. I often joke, Nora, that in my next life, I want to come back as a healthcare M&A banker. They get paid every Monday, it seems.
Always.
They were a little late this week coming in a deal just announced. Merck, New Jersey, as John Tucker rightly points out, agreed to buy Verona Pharmaceuticals for about $10 billion. Just another deal. If you can't find it in your lab, in your R&D, just go out and buy it. So we want to see what's happening with our good friends at Merck, and we got some folks who do that for us. Damien Gardet joins us, Bloomberg News healthcare reporter. What's Merck doing here, Damien? What are they trying to accomplish here with $10 billion, which to me is a big number. I know to them it's not that big a number.
It's mid-size in pharma world, yeah. And in this case, Merck is acquiring an approved medicine for COPD, the respiratory disease that includes emphysema and other kind of related conditions. And they're paying $10 billion for this medicine that they believe can reach mid-single-digit, multi-billion-dollar revenues in the coming decade. And in terms of how this fits within Merck's strategy, they're a massive global pharmaceutical company, and they make the world's best-selling drug in the form of Keytruda, which treats a bunch of cancers.
So Keytruda is a best-selling drug, like, anywhere?
In the history of pharma. Now, some of that is inflation-related, like the dollars that it puts up. If we adjusted for inflation, perhaps, some antibiotics from the past might contend with it, but
pretty good.
With the numbers we have, it's the biggest drug in the history of the world, but like all drugs, it has a finite patent life. And in the case of Keytruda, it will lose patent protection in the United States and around the world later this decade. So that's a $30 billion, roughly, annual product, that cancer drug, and it's about 50% of Merck's revenue. So you can imagine they got to replace it. So this deal, in adding this one drug that Verona Pharmaceuticals got approved last year, is by no means going to replace Keytruda in one bet, and Merck wouldn't aspire to do that. I think they're taking kind of like a Moneyball approach here, that Keytruda will one day erode and eventually go away, and they can't replace it in one fell swoop, but they can perhaps do so in the aggregate by acquiring products like this.
So, Damien, how does this compare, just kind of contextualize this for us, how does this compare to some of Merck's previous deals?
They have been biased toward things on the small side, I would say. They say constantly we're in the $1 to $15 billion range, and they look at it as bolt-ons. So what Merck would say is we look first for good science out in the world, a promising approach to a disease that needs new therapies. If we like it, if it jives with what we're good at, we'll go out and pay for it. But they have not historically been interested in like mega mergers, something over $10 to $15 billion, as some of their competitors have done. And I think what Merck and many analysts would say is that when you go back and look at those mega deals in the drug space, they're often not accretive in the long term. There's a lot of waste. There's a lot of red tape that gets tied up. And so I think Merck's approach is very much, we know what we're doing. We can spot what's good out there in the world, and we'll bring it in when it works for us.
When a drug goes off patent, particularly as one as successful as Keytruda, how does that erosion process work? Is it 50% in the first year, then it evens out, or is it just kind of a couple of percent every year, just kind of losing share?
It varies, and this gets a little bit into the weeds, but the famous patent cliffs we might remember of like Lipitor, for example, where it was like 80% the next day. Those are pills.
Is that right?
It was maybe not the next day.
No, but I get you. But
it was a massive drop. That's because those are pills and they're relatively easy to make. Right. Keytruda is a complex injectable medicine called a biologic, and technically there's no such thing as a generic. There are biosimilars. We don't need to get into the weeds there, but basically what we've seen for drugs like Humira, which was previously the best-selling product in the world, which is also a biologic, that the erosion curve is much less steep than it is with pills, for example. So the expectation is that by about 5 years from Keytruda losing its patent expiration, the net price would come down about 50%. And that's very dramatically different from, as we said, with the pills where it's like almost instantaneously decimated.
Damien, does this signal a comeback in deal-making for the pharma sector?
That's what everybody has been kind of looking for in 2025 and even late last year, because the valuations of biotech companies have been so beaten down in recent years that you would think, or it would follow logic, that the Mercks of the world would be like, oh, wow, there's bargains out there to be had. But what we're learning time and again is two things. One, just because a biotech company's valuation is down doesn't mean its CEO and its board think that that valuation is correct. So if you come in with an offer that's based on my current valuation, I might say, well, I think I'm worth twice that. And if we just wait, then the market will prove me correct. And that stands in the way of deals. And then also pharma companies don't necessarily think that way about like bargain shopping. They think about like, we need a new cancer drug. We need a new drug for a lung condition. So whether this signals a turnaround, I would be loath to make that prediction because it is so idiosyncratic out there.
Yeah. University of Mexico?
That's right.
You're not alone. Anastasia Amoroso, one of the best investment strategists out there, who sits in that seat all the time when we have her as a guest. She's also a university.
Really? Okay.
So there's two of you in New York.
Interesting.
There's at least two of us
in New York. Very good. Damien Gardet, thank you so much for that. Appreciate you reporting there. Another big pharma deal. Why not? They've got tons of dough. And again, it just seems to me as an outsider, if you can't develop it in your R&D lab, go out and buy it.
Definitely.
All right, looking at the market here, we continue to hold gains here, up about 0.3% on the S&P 500. Coming up, Tim Craighead, Bloomberg Intelligence Chief Content Officer on banking, booze, and 007's wheels. I don't know what he's talking about.
I'm curious.
We're going to have some good ideas, because that's Tim Craighead. He brings it every time. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. NVIDIA hitting $4 trillion. This is the first company in history to achieve this milestone. It's also giving a lift to the rest of the market. The Bloomberg Mag 7 index, that is up 1% right now. NVIDIA shares up 1.2%, $163.12 a share. Today, shares of Freeport-McMoRan, they're down 1.5%. President Trump did announce the 50% tariff on copper imports. Don't know when that's going to take place, if at all. Contracts, interestingly enough, on the COMEX, they surged to an unprecedented 25% premium over what's considered the benchmark price at the London Metals Exchange. So what that tells you is it suggests the market not really convinced that these tariffs are going to take hold. Investors are going to seek clues for more insight on Fed policy path. The latest FOMC meeting minutes were released later today. Also get an auction, treasury auction. I know you're all excited about that. Starbucks receiving proposals from prospective investors in its China business, most of whom are eyeing a controlling stake in the operation. The company now in the process of sifting through a bunch of these proposals. They're going to shortlist a group of potential investors for a next round of bidding. And those shares, they were higher today. Right now, the Dow Jones Industrial Average, 70 points higher. That's up 0.2%. The S&P 500 up 19 points. That's up 0.3% right now. The NASDAQ 100 is up 95 points. That's a rise of about 0.4%. So we sort of paired some of the early gains in the markets right now. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Nora.
Thanks, John. You brought up Starbucks. Are you a Starbucks person? I know
Good
Paul
Lord,
has a
no.
very specific order, some double
short mocha,
triple double, something.
Triple
I should remember it by
short
now.
mocha, half laugh, cafe, whatever. Why would you pay like $10 for a cup of coffee when you go upstairs and it's free?
Exactly right. Red headline crossing the terminal right now. Linda Yaccarino says she is stepping down as CEO of Yext. Who did not see that coming? But we'll have more reporting on that. But you just knew that was coming.
No, for sure. Lots to look at right now. But I do want to turn to Tim Craighead, and he's based in London. He's joining us via Zoom. He's a research director for content for Bloomberg Intelligence. And I'm looking at this story that's out right now, and lots of really interesting illustrations. But the story is called Banking, Booze, and 007 Wheels, 10 companies to watch right now. Paul, I have no idea where this is going. I'm so curious just based off the headline alone.
Let's do it.
But Tim, contextualize this for us. Tell us, what is this list?
Yep, sure thing. Thanks for having me on. So these 10 ideas are all part of a broader list of what we call focus ideas. Focus ideas are where our analysts around the globe, across regions, across sectors, have high conviction, fundamental points of view that they think are different from what the market thinks, anti-consensus, and importantly, they're catalysts coming up that we think can change market perceptions. And these 10 all have important catalysts coming up during the third quarter. And just to put it out there, you can see all of these focus ideas on BI Focus on the terminal.
Tim, what I like about these ideas, because people are always looking for ideas, long and short. You guys have the ideas, and what I really like about this research format is you have the triggers. What has to happen in order for this call to work on a particular stock? Aston Martin, I'm asking for Matt Miller. What's the call here on Aston Martin?
So the call on Aston Martin, as much as I like the cars, and obviously this is where the 007 reference comes from, they've got a really interesting new lineup of vehicles, but they're short on V12s. And notwithstanding the world of EVs and all that sort of stuff, high-end V12s from Ferrari and Lamborghini are hot. And you look at the inventory levels of Aston Martin on the lots, they're too high. We think that there's a capital infusion that's likely needed in coming months. And so we actually have a cautious view on Aston Martin from that perspective.
Tim, you all are always putting out super interesting stuff. I mean, we had 50 companies to watch in January, and then we had the quarterly update in April, and then, of course, now this story that's out. Loving the graphics here. How long did it take to put this together?
Well, it's an ongoing just process of working with our analysts in terms of where do we see these ideas coming from, and then our friends in Business Week like to pull together the graphics on these things. It is a good looking piece on the on Bloomberg.com.
Booz, Diageo, what's the story there?
Yeah, Diageo, it ties in a little bit with a couple of ideas here. I mentioned Aston Martin. That's obviously a high-end consumer idea. And even though we're concerned about Aston Martin specifically, the high-end luxury vehicle market is good. Similarly with Diageo, high-end booze, high-end spirits, they are the world's largest spirits manufacturer, is doing relatively well. Their recent sales trends have been robust. We think that's going to continue to show through. There has been concern about things like tariffs and what could be the impact, especially from a U.S. consumer base. We're less concerned and we're optimistic. Another consumer higher end idea you guys know and love in the States is Dick's Sporting Goods. This is a classic good old consumers growth story where not only do you know the store, but you might have been in one of their new bigger formats where they have that much more kit. Their sales trends continue to be quite good despite concerns about what are tariffs going to mean for consumer here or there. So those are all consumer ideas. There's certainly a common thread there.
You mentioned Dick's, and I'm looking at EasyJet, which of course we know is a low-cost British airline, and we have a sunny outlook here. But what do you think will be the most surprising call here for readers?
Yeah, it's interesting. In this instance, obviously this is not the high-end consumer. This is everyday consumer, is that this isn't so much about the demand, which actually demand for travel and experience continues to be pretty good. This is more of a story on an operational basis. They're replacing a lot of older planes with newer planes that have bigger capacity and much more fuel efficient. So this is a margin story. EasyJet has historically lagged behind Ryanair, the other low-cost carrier here in Europe. We think that that's set to change.
Tim, you live and work in London, but as most of our listeners can tell, you're not an Englishman. You're from the great Commonwealth of Virginia. Talk to us. Are the tourists, is it as crazy in London this year as it's been in recent years? What's the tourism factor there in London these days?
The quick answer is yes, notwithstanding the fact that the pound is actually pretty robust as of late. Streets are busy, and it's true in the city. Walk out the door here, Tuesday, Wednesday, Thursday are the new Friday, and it has been a warm summer, but this is also the time for Wimbledon, and beyond that it's just been busy with people coming from all over the world, whether it's China, whether it's the US. This seems to be a hot ticket. So yeah, it still feels pretty good.
Yeah, I'm trying to get Audrey Child-Friedman to get the euro back to parity, because I'm coming over to Europe in the fall, a little vacation, a little holiday. But I mean, you mentioned the pound sterling, but the euro 117, that gets your attention.
Yeah, it does. Well, and I guess from our perspective, and primarily Audrey's perspective, this is a weak dollar story, yep, as opposed to stronger other currency story. And yep, we think that there's more legs to this. One of the big themes that comes up in all the investor discussions or events that I'm at is the long-standing premise of American exceptionalism. You pop money in U.S. bonds, U.S. stocks, and they take money off. Yep. Is that holding? Yep. Valuations a lot more interesting elsewhere.
All right, Tim, great stuff as always. Tim Craighead, Chief Content Officer, Bloomberg Intelligence. All right, folks, join me and Tom Keene tomorrow at 9:30 a.m. Wall Street time. We welcome New York City Mayor Eric Adams live and in studio. That's on Bloomberg Radio, Bloomberg Television,
and Bloomberg podcast page on YouTube. Mayor Adams in studio tomorrow.
Listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
Welcome back to Bloomberg Intelligence Radio. I'm Norma Linda here with Paul Sweeney, and it is Wednesday morning. We're seeing stocks that are higher right now. We've got communication services and consumer discretionary as some of the best performing sectors in the S&P 500 right now. Lots to keep an eye on today, but we want to talk to Jennifer Rhee. She is Bloomberg Intelligence Senior Litigation Analyst, and we're going to be chatting a little bit about the U.S. antitrust environment and what the second half of this year looks like. I mean, Jennifer, the antitrust environment was pretty aggressive under the Biden administration. We were seeing a lot of those larger companies getting caught in the crosshairs here. Can you set up for us what it looks like right now under the new administration?
You know, that's right, Nora. It was a really tough 4 years, particularly for deal makers. And I think, you know, there was a lot of uncertainty going into the election during the fourth quarter of last year. But I think there's some really good signs for those companies that want to engage in big deals going forward. And the main reason is because Trump's antitrust enforcers are willing to accept settlements with a remedy to allow a bigger deal to close, essentially meaning that if there's an overlapping product and there'd be too much concentration in the market for that product line can be sold and the larger deal can get closed. And the Biden administration essentially refused to do that. They thought if a deal was problematic, we're just going to sue it and try to block it. And it led to a lot of lawsuits, a lot of abandonments, and a lot of deals that just didn't get signed to begin with. So because we're seeing this sign that deals can get settled, I do think we're going to start to see more bigger deals getting signed up in the second half and probably next year too.
So, you know, for all these agencies within Washington, they obviously feel the presence of President Trump very keenly. The folks that are in charge of the Federal Trade Commission, the Department of Justice, how much independence do you think they have at this point?
You know, Paul, probably not very much. You know, in the past, in particular, the Federal Trade Commission was supposed to be quite independent. And really, it was because it had 5 commissioners, only 3 of which could be from one political party, and they needed a majority vote to take any action with the deal. But President Trump has fired the 2 Democrats. So we now have 3 Republicans, and we have 3 Republicans that very much are behind him and his political visions. So I think that they will essentially do what they think he wants done. And we have seen an example of that because they did clear a deal between 2 huge ad agencies, Omnicom and Interpublic, with what we call a behavioral agreement, which they have said that they don't tend to want to take, agreeing that they wouldn't prevent advertisers from advertising next to content that was right-leaning or expressed conservative viewpoints that they might not agree with. So that was very much kind of in line with this administration and what this administration wants. So I do think we're going to see alignment in terms of what these remedies are and the deals that get cleared with what Trump is saying and with what Trump wants.
Mm-hmm. So Trump terminated 2 Democratic FTC commissioners back in the first quarter of this year. And of course, we know this did raise some significant constitutional concerns in terms of the commission's historical independence and, of course, enforcement efforts. What has this really signaled in terms of potential policy changes?
Well, you know, the thing is that, first of all, all of these challenges are going up to the Supreme Court. And we do think that this is going to stick. We do think that because of some of the other decisions about other agencies, that even though the 2 Democrats do have an ongoing lawsuit about their termination, we think that probably the Supreme Court is going to side with Trump and they are going to remain terminated. For practical purposes, as I said, I don't think that there's very much impact here because you do need a majority vote to settle or to sue to block a deal. So you need 3 out of the 5. In the past, we have seen that the FTC's operated on a very sort of bipartisan or nonpartisan basis. We usually have a unanimous or maybe a 4-to-1 decision, but it hasn't been that way. You know, starting with Biden, we were seeing a lot of 3-to-2 decisions where along party lines, right? So I think that we probably would have continued to see that. Even if the 2 Democrats were still there, you'd have the 3 Republicans. You'd probably get your 3-to-2 vote to do whatever it was that the Republican contingent wanted. So from a practical standpoint, it's not going to have that much impact on the decision-making for deals of this FTC.
Are there any deals that are currently being held up or being scrutinized that maybe the participants are saying, oh boy, now we're going to really sail through? We thought maybe under Biden it could be a tough slide, or anything we should keep an eye on?
You know, Paul, the one I'm really interested in is the Google Wiz deal. And I say that because we know this administration is no friend to big tech, and we know that they're staying really aggressive on the monopolistic conduct side, where Google and Apple and Amazon and Facebook have all been sued for monopolistic conduct. And to me, that deal is very interesting because just from an antitrust perspective, I don't really think it poses antitrust concerns. You know, the concern would be that you have a cloud company that's marrying with a cloud security company, and they could foreclose rivals. But I think that there's ample competition on both sides, both on the cloud side and the cloud security side, that you probably don't have a very strong theory of harm. But we know that this administration doesn't necessarily love Google. I'm going to be interested to see what happens there, but I suspect we're not going to learn in the second half. It's probably going to push into the beginning of next year.
All right, Jen, thanks so much for joining us. Jen Reese, Senior Litigation Analyst for Bloomberg Intelligence. He's got the deep dive kind of looking at the whole antitrust world under President Trump. You can find that on the Bloomberg Terminal. It's a great read, detailed, long report with a lot of good stuff in there. Sam Fazeli, Senior Healthcare Analyst for Bloomberg Intelligence over in London, just emailed me something. It says, breaking news, U.S. measles cases in 2025 break 33-year record. So there you go. Since the disease was declared eliminated 33 years ago. So wow. We've got that for you. All right, folks, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence, that starts right now.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, coming up in this hour, Miami Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. What's going on with copper? He knows. He's the commodities person. He's got all the details. The most read article of the last 8 hours on the Bloomberg terminal is this one. Goldman asked junior bankers to swear they haven't landed PE jobs. Go crazy on that one. Sally Bakewell, Bloomberg U.S. finance team leader. She's going to join us and break down what's going on there. Ed Ludlow, he's out there in Sun Valley, Idaho, with all the media and tech tycoons. We'll get the latest reporting from Ed and some bushes. I'm sure he's in waiting to find some executive to interview. Jeff Langbaum, Bloomberg Intelligence senior REIT analyst, give us the mid-year outlook on REITs here as rates remain higher for longer. Right now, let's go to Charlie Pell and get a Bloomberg Business Flash.
Hi, thank you very much, Paul and Nora. Here's what's going on. We got the Dow, the S&P, NASDAQ all pushing higher. Lots of moving parts to this market today. We've got a rally in some of the world's largest tech companies that is spurring an overall rebound in stocks. Thank you, NVIDIA. NVIDIA right now, $4 trillion. Yeah, the guy on the radio said it right. $4 trillion market cap, up by 2%. Right now, the S&P advancing 13 points. That is a gain of 0.2%. 6238 on the S&P 500 index. The Dow up 55, up 0.1%. NASDAQ up 93, gain there of 0.5%. And our Mag 7 index surging by 0.8%. NVIDIA bears repeating, up by 2%. Your 10-year 4.37%, with the 2-year 3.86%. Spot gold up $9 the ounce, up 0.3%. 33.11 the ounce. And West Texas Intermediate crude, let's call it flat on the day right now because it is $68.32 a barrel on WTI. Brent holding above $70 a barrel, 70.11 right now on Brent. Bitcoin up just about 0.4%, 109,112 on Bitcoin. Earnings right around the corner. JP Morgan Chase next Tuesday. So what is the question to be answered once we get those reports? Peter Cheer is head of macro strategy at Academy Securities. He was interviewed right here last hour on Bloomberg Intelligence.
Do we still have tariff uncertainty? And I think the market's pricing that we don't, but it feels to me that it is there. And I think corporations are actually going to support that view, that they are still hesitant to do a lot of spending away from AI because that's just developing efficiencies until they get more clarity.
Peter Cheer of Academy, interviewed right here on Intelligence. Again, stocks are advancing. NVIDIA, the big stock story today, surging by 2.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that as Charlie's just reporting. Lots of green on the screen here today. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Norma Linda. We're joined by Bloomberg's Isabel Lee. Isabel, what are you looking at today?
We have to start with power firm AES. We have shares soaring around 17%. Ticker is AES. So the company is exploring options, including a potential sale, sources told Bloomberg. So AES provides power to tech giants like Microsoft, Amazon, and Google. And investors, including Brookfield and BlackRock, have been studying AES after the company shares really lost about half of their value in 2 years. And of course, that comes as Trump has put in place anti-renewable policies. So here's the catch. AES has an enterprise value of $40 billion. So even a leveraged buyout would rank it among the biggest of all time. So investors are definitely excited about that.
Isabel, earlier on TV, I heard you saying that you are a fan of Starbucks, and that's one of the stocks that you're looking at. We also got the redhead earlier, that Linda Yaccarino, who's only been at X for about 2 years. I don't know why I'm bringing her up regarding Starbucks right now, but that's lots of news that we've really been looking at. We'll talk about that a little bit later. I clearly wanted to talk about it now, but
I do
what's going on with Starbucks?
I do love Starbucks because it tastes the same all over the world. So if I order a cafe mocha here, it tastes the same as back home in the Philippines. And I just like that about the stock. So SBUX, SBUX, is up 0.5%. So the company is receiving proposals from potential investors in its China business, according to, again, people familiar with the matter. And most of them are eyeing a potential controlling stake. So China is the second biggest market of Starbucks. And Bloomberg first reported in May that it's kicking off off a review process of its China business, which has been struggling as really a lackluster economy and really rivals grow. So now Starbucks is in the process of sifting through those proposals and shortlisting options. So this wasn't Starbucks' preferred option. Of course, they just wanted a minority stake partner that could help them return to growth. But here we are. So a fun fact, Starbucks has been trying to attract local customers through introducing more sugar-free options and really slashing tea beverages. A lot of Asians like to drink tea, although we're not generalizing here.
Hold it, but if you're in the Philippines, I understand it's a little warm there, like every single day of the year. You drinking hot coffee?
I personally drink hot coffee even if I'm sweating my whole
Wow.
body up. But you can order frappuccino, cold
Macchiato.
stuff. Yes, everything. You can make a hot drink iced, but it's big in the Philippines.
And I heard they're bringing protein, right? Protein drinks to Starbucks as well, allegedly.
That I didn't know.
All right, real quick, NVIDIA, that's got a headline.
It's the biggest story today, I think. Shares are edging higher by almost 2%. So they're the first company to achieve a $4 trillion market cap, really just cementing its status as the leader in the space, the leader in the global market. So shares jump around 2.8 earlier, and that was what brought NVIDIA to crack the milestone. So remember DeepSeek? I think everyone forgot about that. And the stock has risen 20% in 2025 and up more than 1,000% since the beginning of 2023. So really, NVIDIA is a stock to see. Really amazing growth.
Well, thank you so much, Isabel. Lots of good stocks to talk about. For more conversations like this, subscribe to our new Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, and anywhere you listen. But I do want to move on. We've been talking about copper a lot today, Paul. I mean, that's really just been so many headlines regarding tariffs and copper here, and we're going to be chatting with Mike McGlone. He is Bloomberg Intelligence senior commodity strategist. He's based in Miami. I can only imagine with the heat here in New York what it's like over there right now in Florida.
It's the same.
Is it? Okay.
That goes to my, people say, oh, it's too hot here in the summer. It's the same. It's hot here in New York. So,
but they've got the palm trees, right? So
yeah, they got palm trees.
a little bit better. We'll have to hear what Mike has to say about that. But Mike, turmoil in the copper market. What's going on after this 50% copper tariffs that President Trump has initiated?
Well, Nora, I'm afraid we saw a spike yesterday that might be akin to July of 2008 when the daily average national gasoline price first went above $4 a gallon and crude oil peaked at $147. It's really a distortion because it's only U.S. copper prices that are going up, and they're 30% above what's the rest of the world trading in London. So that's really a tax on economic activity. It's a pressure factor. In the past, you know, copper is known as a leading economic indicator. It might have shifted to the reverse now. So I'm really concerned about this. But for now, the thing is, Trump did say 50%. I think maybe regionally might go back to 15%, but 50% is very extreme. It's a big, major pressure factor, and all the people who need copper and use copper in this country, particularly with the trend towards electrification.
All right, I'm looking at the CMX copper. It's $5.50. Down 3% today after that big move higher. How do you expect this thing to trade in the coming days, Mike?
Well, that's the key thing. We have to wait for every Trump tweet, because if he comes out and says it's going to be less than 50%, which I expect, I don't think it's going to be more. I think at some point there'll be a pullback. Expect it to collapse. It can collapse a lot. I mean, it can drop 20% just to get back to where it's trading on the LME. The ARB's going to eventually ARB this all out. But right now, we're in a very unique stage where you can't, if you're a trader in position, you just have to watch tweets from Trump to see what's going to matter with copper. In the meantime, this high price is going to pressure demand, and it's going to increase supply. It's just going to take some time for the supply to come on.
Mike, can you speak a little bit more about copper derivatives and how that differs in terms of the impact here from the raw copper?
Well, again, that's my background is futures. So the key thing is copper futures. That, as Paul mentioned, that COMEX traded copper, which is a CME now. The key thing about copper, it is one of the most negatively correlated to the dollar. And the futures are the curve is almost always very flat because it can easily store copper versus things like crude oil and corn. It's hard to store. You have a curve that's generally in contango. You have to pay for that pressure or for that storage. Copper is generally pretty flat, and the futures are generally very closely armed between what's trades in LME and CME. This year's distortion is the most ever. And I think we're going to look back at it from the future and say, yeah, that was probably a pretty good peak. akin to 2008. So that's the way I see it right now. It's the futures that really drive the market. And one thing, remember, you can get a lot more leverage in futures than cash, and cash always then and end up eventually settling to that futures price.
Yeah, that was a risky life you led there back in the day, Mike. Futures, leverage on futures. All right, let's talk about oil, WTI crude oil. It seems like that risk premium from the attack on Iran that maybe has kind of come out of oil. Where do you think the fundamentals are for oil right now?
Prices continuing down. That risk premium, that spike was the classic fuel for a bear market. Hedgers, speculators have seen the market get really cheap around $55 a barrel. That was a new low this year. That was essentially near the U.S. break-even cost. Said, okay, I have to back off and wait for a spike. They got it, and they sold into it. So all these producers in Permian and a lot of the rest of the world said, thank you. I can sell forward. You can see that in backwardation, bring on my supply. And we have futures against that. So now the price continues lower. OPEC's in the space. Remember, everything that here from OPEC is somewhat becoming redundant. OPEC's becoming less a factor in the market. What really matters now is supply out of the U.S. and Canada and America, non-OPEC supply, and demand from China. Supply is increasing, demand from China is decreasing or stagnant, and OPEC is just coming back on. The key thing about OPEC coming is they're coming in a good time because the front price is higher than the back price. That's backwardation. That's when you're supposed to bring on supply. Take advantage of that front price. And when that back price goes higher than the front, that's when you curtail and you hold your inventory. So right now it's a bear market. It's bounced. And I do think eventually, I'll keep saying it, I've been saying for 3 years, crude oil is going to get to $40 a barrel. Have you heard that from me before yet, Paul?
Yes, we have. We have, and it was, basically buy gold and sell everything else. I heard that about 1 million years ago, and he's been spot on that. Mike McGlone, thanks so much for joining us. Mike McGlone, he is a senior commodity strategist for Bloomberg Intelligence. He's down there in Miami. All right, folks, if you're sitting in front of a terminal, type in read go. And over the last 8 hours, the #1 read story has been about Goldman Sachs. Goldman asking their analysts to swear they haven't lined up PE jobs. I have no idea what's going on here. Back in my day, you worked 2 to 3 years, you went and got your MBA, you came back as an associate to double your money, and then you just kind of moved on and onward upwards. It ain't that way right now. Sally Bakewell joins us, Bloomberg U.S. Finance team leader joins us here. Sally, what's the story of Goldman Sachs here?
Right.
They have to asking their associates or their analysts to swear?
That's right. And also, just to say, back in your day, couldn't have been obviously that long ago. But yes, Goldman Sachs is asking its incoming class of analysts to effectively take a bit of its own kind of pledge of allegiance to the bank and certify that every 3 months they're not accepting an offer from basically a private equity firm.
Now, is this accepting? I haven't even started Goldman Sachs, but I've already accepted something at KKR like 2 years later?
Exactly. This is the practice.
So I'm interviewing at Goldman Sachs for a job, and I'm interviewing at KKR for a job?
Yes.
Planners.
Gotcha. Okay, that makes sense.
Doesn't it sound
That's
kind
a
of
great
horrific,
system.
honestly? But yes, it's known as on-cycle recruitment. And it's this practice where private equity firms try and recruit incoming junior bankers who maybe haven't even officially got in the door at their bank programs, analyst programs, and line them up to take on private equity jobs as soon as they finish those analyst programs. And you can kind of understand why. They get this fully trained, fully formed mini junior banker and they haven't had to pay a penny to train them.
Yep.
I honestly feel like these big banks are always doing something that surprises me. There's always news coming out of these things, and I'm like, what's going on with the young bankers here? But
well, the reason I think the banks have allowed this to kind of happen, because who is Goldman Sachs' biggest customers? The private equity firms. You don't want to upset them.
Fair.
It's kind of a quid pro quo. We'll train these kids. If they want to go and work for you, fine. It works for us long term because we've got a Goldman or Morgan Stanley alum that's now at KKR, and who knows where that person will be 10 years from now. That could be a big player, and it all kind of works out. But it's gotten silly now, hasn't it?
Is it uncommon? I mean, are we seeing a lot of other banks doing some of these stringent rules?
So a few banks have started to push back.
Okay.
JP Morgan was the first in recent months. Jamie Dimon has actually called this practice of on-cycle recruitment unethical and warned that he wanted to eliminate it because he says it puts the junior bankers in a difficult position. They're barely in the door at a bank and they already have to start thinking about a career, and they don't even know at that stage what they might want, what they might be good at.
Fresh out of college probably as well.
Yeah, fresh out of college. And so JP Morgan earlier this month, it actually told incoming graduates that if they do accept offers during their first 18 months at the bank, they will be fired. So it was a very clear message. And actually some private equity firms have pulled back since then. Apollo is one, General Atlantic is another. They've actually said to their candidates that they will not be recruiting, they will not be doing this on-cycle recruiting and recruiting junior analysts so early.
It's, yeah, it's just crazy. I know times have changed. I mean, it used to be you work 2 to 3 years as an analyst at an investment bank like I did, and then they literally kick you out the door and say, go get your MBA. You go get your MBA, you come back, and you double your money, and you kind of do the same job as you were doing 2 years ago. It was that in itself was kind of an odd situation, but now they don't even force you to go get an MBA because they don't want to lose you. I mean, you know, lose you to anybody. So,
but are they having trouble with recruits? I mean,
no, it's still
they're still
27
getting the
resumes for one slot. You think this is going to hold, Sal? Do you think?
I think that's the big question. Does this spell the end of the practice? Probably not. I think it depends how competitive the market gets. Banks have periodically made bursts of effort over the last 10 years or so. Morgan Stanley did back in 2013. That didn't really go anywhere. So they've tried to sort of stem this tide. Whether it takes hold permanently, I think it's almost impossible to say. It will depend on market dynamics. But this is certainly one moment where they seem to have created this pullback by private equity from doing this.
I mean, as a prospective junior banker, can you really even scout out a different bank, or are they all doing the same thing?
I think that's a great question. And I mean, I think this is part of the rationale for that private equity firms are at least saying, you know, that at that stage in your career, you don't know what you're doing. I certainly didn't know what I was doing at that age. I still barely do. So how can you make this kind of decision? And it also puts you in a conflict of interest position. You know, you're in a bank, you have access to the bank's confidential information, but you're already committed to a private equity job. I mean, that's not a good position to be in.
Yeah, it's tough for the junior people from a, if not conflict of interest thing, and it's just an odd economic model. I never really understood why they did it that way. So anyway, it's on the Bloomberg terminal. It's probably on Bloomberg.com by now. The #1 red story out there. Goldman asked analysts to swear they haven't lined up PE jobs. So I guess it's a pinky swear. I'm not sure how that all works, but Sarah Bakewell joins us there, and we appreciate her reporting on that story and taking the time to come into our studio. All right, folks, join me and Tom Keene tomorrow at 9:30 a.m. Wall Street time. We welcome New York City Mayor Eric Adams live and in studio. That's on Bloomberg Radio, Bloomberg Television, and the Bloomberg podcast page on YouTube. So Eric Adams in quite a fight here for the mayor race. So we'll have to see what he has to say tomorrow morning, but check that out. Market's giving up some of their gains here. The S&P is pretty much unchanged now. Had been up about 0.2 to 0.3%, kind of almost break even right here. The Dow up 5 points and the NASDAQ up 75 points here. Looking at the yield space, the 10-year Treasury coming in a couple of basis points, 4.37%. Bitcoin, it's higher, 109,000.